I'm sure you remember the video of when they unveiled the Vision Pro and they read out the price of it and the audience gasped. It was a viral moment. It was pretty funny. Who's going to buy these? Is this just people who love Apple enthusiasts? And are we going to see the price tag come down from several thousands of dollars?
Yeah, you're going to see software developers who want to develop for the platform. You're going to see mixed reality enthusiasts. You're going to see not the early adopters. I think the early adopters are the people who buy the new iPhones the first day or week they come out. But I think you're going to see the early adopters, right? That is an even more niche audience. I'm not expecting lines outside of Apple stores. You know, they believe over the course of a year, they're only going to sell a couple of these at most a day in each of its retail stores, right? So this is a niche product, probably in the same spectrum as people who would buy a Mac Pro or a high-end Mac Studio. Yeah. Those are the company's most expensive Macs, right? You're talking $3,500 plus $500 in tax in the U.S.
Yeah, not for the lighthearted or the small pocketbooks.
No.
Mark, always appreciate it. Mark is always my go-to. Is it time for me to upgrade a watch, a phone? That's who I talk to. Mark Gurman, thank you so much. Happy New Year. Bloomberg's own Mark Gurman. When it comes to Apple, a must-read here at Bloomberg.
Yeah, it's definitely, as he concurs with Wedbush Securities, we can make it to the 4 trillion mark, and it sounds as if it's going to be a litigious kind of year for Apple going forward. Quick snapshot of what we've got going on. There's a little bit of a turnaround in some of these global bond yields. They're rising. Equities are flat, though. Look at that, 48.29. Eurodollar is like a pancake, 110.56. But will the ECB be forced to cut more aggressively than the Fed? That is the debate. Global bond yields are bouncing. We'll take a look at that in just a moment. BMO Wealth Management joins the team in just a moment.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a special edition of Bloomberg Surveillance alongside Carol Massa and Katie Greifield. Good morning. I'm Manus Cranny. We're just moments away from the cash trading here on this last trading day of 2023. As you can see, we're just moments away. We're going to roll it over. This is where we are. Stocks can coexist in a high interest rate environment, according to Nancy Tengler. This is what we got, 48.28.5 is where we are. The market is now open. This is the cash drop. Euro dollar trades at 110.55. The dollar's had its weakest year since 2020. The euro, of course, is the fourth best performing currency against the US Yankee this year. Yields trade at 388 as there was a little bit of indigestion on the 7-year auction last night, with the dealers getting left with a little bit more than they had anticipated. Oil is marching higher now, $72, and Rita Sen was with us. Her call is to the 80, from $80 to $85. The war premium is underappreciated and underpriced. What is moving in equities? We'll get to Abigail Doolittle. She joins the team around the desk for the opening.
Well, good morning and happy New Year to everybody. The stock that I wanted to take a look at first is one that we looked at yesterday. It's not up as much as it had been earlier on the session, in the pre-market, I should say, but I'm talking about Altice USA, up for I believe it's a 6-day in a row, something along those lines, the best month on record, up 42%. And we had talked about a report that they may be selling Cheddar to a PE firm. They did, in fact, sell Cheddar to a different firm, to Archetype. It looks like a positive for the company. In addition, we do have one analyst saying that the general activity around Patrick Drahi's European assets is also creating this stir. And right now it is up 1.7%. Fisker, the EV company, shares are soaring, up more than 10%. Their fourth quarter deliveries surged 300% sequentially. Now, these are smaller numbers, but clearly moving in the right direction. They produced on the year more than 10,000 EVs. They delivered 4,700. There's a 42% short interest on this stock, and you'll notice it is a penny stock, so a bit of a squeeze. As for some of the big names, any guesses on what the best stock of the year is and the worst?
NVIDIA!
You got it. And it's heading to its best year since, I believe, 2001 on the blowout guides that we've seen from that company.
Right?
Yeah, it's a long time.
But it's amazing that it's not a record, really?
Well, you know, it's funny that you're saying that because I thought the same thing. Yeah, in 1 year it was up more than 300%, which is pretty incredible. And that's true for a stock that I was going to look at, CrowdStrike, which is also one of the top 4 stocks. We don't have it on the board, but it's only the best year since 2020, since it was up 300% that year. But we do have Meta on the year. That is the best year. That's the best year since going public in 2013. But I did want to take a look at the 2 worst stocks, because you sometimes...
The year of efficiency, right?
Yeah,
yes, year of efficiency. It seems to have paid off. But we have Enphase Energy. It's heading to its worst year since 2016, and FMC, the worst year since 1986. Now, you've heard of the dog of the Dow of the dog theory, or whatever that is, like the worst and the best.
Those that stunk, you buy them in the new year,
basically? Yeah, exactly. So maybe Enphase Energy and FMC are going to be stocks to own. In fact, some are saying that Enphase Energy, it's backed by cash and low capex requirements. So
if you ask Katie where she's going, where are you going to shop?
I'm not going to Abercrombie, but a lot of the teams are out in full force, apparently. 300% higher.
She's happy with
year.
that.
Yeah.
Hey, Carnival's on that list. They're in the top 10.
Are they in the top 10?
Yeah, up 131%. Number 6. We've got the CEO coming up, so it'll be interesting to see about kind of the outlook for the new year.
Nice.
Yeah.
Okay, Abigail, thank you so much.
Happy New Year.
Happy New Year.
Enjoy wherever you are, and to you out there, enjoy wherever you are as well. Let's bring in Youngyu Ma, CIO at BMO Wealth Management. Good to have you with us. I like the fact that you've taken a slightly contrarian view here. You talk about value equities rather than those concentrated in the mega cap companies will be the shining example of good wealth management in 2024. Just expand on that, because everybody has come on the show and they have evangelized about you still got to have Mag 7. The earnings growth will be there. They'll be over 20%. But you put this forward about value to growth. The proposition for 2024, lay it out, Youngyu.
Yeah, it's great to be here. We don't want to exclude value, or we don't want to exclude growth in 2024, but we do like how value is positioned. We think growth, there's a lot priced into it already, and value's just been underappreciated for quite some time now. Same with small caps. And even the intersection of that, small cap value is really trading at very low valuations, the type that you see almost at market bottom. So we think these areas are going to gradually be more appreciated in 2024 and have better multiples going forward. So we think the market will be relatively balanced. We don't think that growth is going to soar ahead of value. We don't think that value is going to outperform the way that growth did this year, but it's going to be more balanced. So we certainly want to take a balanced approach given how much value has been underappreciated in the past few years.
To deliver on those value trades in the Russell, this is something, Carol, that you brought up a little bit earlier in the week. We started the show on Tuesday morning. Carol made the point about the catch-up trade with the Russell 2000. What needs to be the lay of the land for that? Does it need to be this fabled soft landing, disinflationary environment with multiple rate cuts? What is it that will give the value and the Russell and the broader church the good foundation to perhaps shine?
Yeah, I think we just need more of the same. We've seen a great backdrop over the past couple of months that will help value stocks and help the rally to remain broad, which we've had and which has been very welcome. I think if we continue to see expectations for interest rates to come down in 2024, for the Fed to cut at least a few times. I don't think we need the Fed to cut 4 or 5 times or 6 times next year, but even 3 or 4 times would be extremely welcome to help some of the small cap stocks and the value stocks as well. Inflation continuing to stay low, a stable labor market where we see wage growth in excess of inflation, so we get real wage growth. I think all of these things just help the broad economy to do well and really reaches down into the mid caps and small caps and the value segments of the market.
Well, on rate cuts, we were talking to Michael Purvis of Tal back in what feels like a year ago, but I think it was just on Tuesday. He was saying that if we do actually...
Not you, Michael. It's just the week.
It's just the week. If we do actually get the magnitude of rate cuts that's priced in right now, that would actually make him less bullish on equities, because 6 rate cuts means that this has gone beyond just normalization. This, maybe we're talking about a downturn. Does that hold water with you when you think about what's priced in and the economic reality that it would take for that to materialize?
I think there's some truth to that. I don't think that we'll see 6 rate cuts next year. I'll be surprised if we even see 4 or 5. But I do think that what's most important is the trajectory that the Fed takes. If we do see economic softness to the degree that the Fed needs to cut 5 or 6 times, yes, that would be unwelcome. I don't think we're going to see that. We think that the elements for economic stabilization and actually reacceleration of growth into the second half look pretty good. So we don't think we're going to see that many rate cuts. We think we'll see a few, and we think that'll be enough. We think that the market will be able to digest, as it's been able to, the higher interest rates that we've had over the past year. We think that will continue, and that the trajectory is much more important than the actual number of 4, 5, or 6, that trajectory that we're going to continue to be down for the Fed in terms of the short-term rates over the next year or two is really going to be what supports the market.
Well, let's take this conversation over to the bond market and what we're expecting there. If your base case plays out, what does this mean for the Treasury market, which really has been sort of the problem child of 2023, at least when it comes to volatility?
It's been a difficult spot for traders, for a lot of investors, for trying to think about where to position and when to position. We actually think that the 10-year yield, which we key off of, is a bit low right now. We don't think that, given our scenario of economic acceleration and growth resuming in the second half of next year, supports or enables a 10-year yield to stay below 4%. So we don't think now is the best time to add duration. We actually recommended clients a few months ago adding duration when we were closer to 5% on the 10-year yield. But we think there will be a better time later in 2024 to add duration. Right now, we're seeing a little bump up in yields the past couple of days. But we think as the economy reaccelerates in the second half of the year, we're going to see yields in the 10-year back above 4%.
Above 4%. Hey, having said that, Young-Yu, 1 year ago, there were 3 calls on Wall Street, and that was sell stocks, buy U.S. Treasuries, and also buy Chinese stocks. we know that that didn't play out. So how are you thinking about the year that was, and maybe how you and your team a little bit humbled? A lot of people got it wrong, so I'm not just pointing, but I'm just curious how maybe you're thinking about and maybe humbled a little bit about how the year played out.
Yeah, it was an interesting 2023. Actually, a year ago at this time, we were even then expecting a soft landing in the U.S. economy. Certainly not everything that we expected went as planned. China, as you mentioned, didn't have the type of growth that we were expecting as well. But we have been talking about a soft landing for over a year now here at BMO Wealth Management, and that's in the latter innings now. We do think that's still in place, and that the elements of a stable labor market and this recalibration to higher interest rates has been pretty well digested by the markets. And we're seeing a stable labor market, a real wage growth, and good spending in areas such as construction and infrastructure. So we think the elements are in place for the soft landing still here.
All right, so constructive and upbeat it sounds like for 2024. What's the one big risk, though, that is on your radar?
Well, I think the one big risk actually that's perhaps underappreciated right now, that the 10-year yield is back well below 4%, is that if we get a resumption of growth and acceleration of growth in the second half, that we're going to see a firming up of those longer-term yields. We could even see a bit of firming up of inflation about a year from now into the end of 2024. And I think that could leave a little bit of disappointment for where the ultimate endpoint is for the Fed in terms of rate cuts. And we think the market will be able to digest that, but we think it might take some of the enthusiasm out of the market to really have a strong rally toward the end of the year next year. But we think the backdrop now looks good. But toward the end of the year, some of the forces that had been concerning previously, we think could resume with the reacceleration of growth.
Young Yu, thank you so much for being with us. Young Yu Ma, of BMO Wealth Management, our guest with his outlook for 2024. We're counting down.
Is that the second person to kind of say that maybe we have to be a little bit worried about an uptick in inflation and that?
Well, he's also, the risk is this, according to the House economic view, is that core PCE could break above 3%, and that could unseat the confidence in the Federal Reserve's, certainly the market's presumption that the Federal Reserve will cut 6 times, as opposed to the Fed's view on 3. But if you're just joining in the program, this is what you've got at 9:41 this morning. The S&P 500 trades at 47.85. That is up 2.5 ticks in the cash, or 0.5%. So it doesn't look as if the mega bulls have stepped in for the last day of trade. They've all left. Where do people from New York go to for their New Year's Eve vacation?
I'm going to Florida.
You're going to Florida?
I'm going to.
She's a snowbird.
A well-worn path from New York to Florida. That's my plan.
Our own little Katie Greifeld snowbird.
Yeah,
Who knew?
flying away.
I think the one price that we just need to check in before we go is the global bond. We talked about this monster rally in global bonds, the US bonds, German and UK. But that has turned around ever so slightly in this last trading day of the year. We were on track for one of our best record run couple of months in a number of years. UK gilts, I should say, just ticking higher. It's not a monster move, but it is just a slight unpicking of this sort of the heft and the rally that you've seen in fixed income.
Who'd have thunk we're ending in a year where both global bonds and global stocks are kind of in sync, right? We're seeing moves to the upside on both, which is not, typically, right, the trade that you see. But to see that that's how we're kind of wrapping up this year is impressive and unexpected.
A gift for 60-40 portfolios, which have been through their own trials and tribulations, but definitely the last 2 months, that's been the place to be.
Well, I think the best phrase that we've heard this morning is the new quasi-active ETFs.
Yeah, passive-like.
I'm still obsessed with Tim Cooked.
Okay. Tim Cooked, passive light. We've got a lot, and we've got weaponized FOMO, and we've got JOMO. We've got a lot of monikers for the team when they come back. We can explain them to John, Tom, and Lisa when they come back. We didn't break anything yet.
No.
And we're not going to. We're going to have a great conversation. Josh Weinstein, Carnival CEO, joins us next on the show.
the reception, the acceptance of Porosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Porosangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
The business cycle lives and dies around the consumer. And the consumer has just been surprising with spending strength throughout this expansion. Over the next year, we're still going to have a healthy consumer. We have a healthy jobs market. We are not going to get the consumer in contraction. But you're going to have a consumer that's maybe a little more moderate and maybe decides that they can wait a little bit or defer some joy instead of taking it all right now.
Lara Rain, Chief U.S. Economist at FS Investments. The consumer is alive. The consumer is strong. Quick snapshot of equities, bonds, and FX as we go into the last leg of 2023. Crude is really the only thing moving up higher at 0.7% to 72.25. Bonds tick higher, and equities are flat on the day, 47.86. But you got 25% this year for your money in equities on the S&P 500.
Not too shabby, but you know what's even done better? Shares of Carnival Corporation. They are the 7th best performer in the S&P 500, up 132% year to date. And we are delighted to have with us on this Friday Carnival's Josh Weinstein. He's President, CEO, and Chief Climate Officer, joining us here on set in New York, in town. Welcome, welcome, welcome. Almost Happy New Year.
Happy New Year to everybody. Thanks for having me.
How are you thinking about the year? I mean, you guys have had a great one in terms of a stock run. You're working on a lot of things in terms of paring down debt. Talk to us. You just reported earnings last week, some pricing power. Talk to us about the kind of the business environment.
Yeah, so the 2023, you know, we wrapped in November, on November 30th, and the one word that we like to use as a summary is record. We had record demand, record yields, record pricing, record bookings, forward bookings, record onboard spending levels. So really across the board, our business has really thrived in 2023, and we expect much more in 2024.
It could continue because you're such a great gauge of how customers are feeling. You know, you have several brands, but you really kind of speak to, the everyday U.S. consumer, if you will. You just have a great read on it. Are they continuing to spend? Are they continuing to do advanced bookings? And then once they're on their ships, Josh, continuing to spend as well?
Yeah, that is exactly what we see. You know, as a matter of fact, our Q4 was, from a pricing standpoint, the highest all year. So it's accelerating, it's not decelerating. And then when we look forward, we're actually 2/3 booked for all of 2024 already.
It's nice visibility.
It's not too bad. We're about 10 points higher than we were last year. And on top of the ticket bookings, we've actually started pulling forward onboard spend. So we have more or less about a third of our onboard spend being prepaid in advance. So we have a really good amount of visibility. And those booking trends, they just haven't slowed down. You know, every quarter this year,
people expected it's gotta slow down. We're gonna see something. The consumer's gonna get impacted. And the fact is, with our business, we haven't seen it. It's record after record. As a matter of fact, we just ended the 2 weeks of Cyber Monday and Black Friday at more records. And it's not just coming from one brand. It's not coming from the United States. It's global. It's with our global portfolio of brands, which is really, really encouraging.
Do you think we're moving, good morning, good to meet you. Do you think we're moving from many CEOs similar to yourselves that I've sat with that run global airlines and global businesses have said, we've lived through a period of revenge tourism. We were all locked up for a period of time. This is something, we had this parabolic reopening and you had a parabolic rebooking. Are we evolving into some kind of new cycle? You say there's no end in sight in this demand. So if we've ended revenge tourism, how would you describe the next evolution?
Yeah, that's a great question. So we don't think this is revenge anymore. This is not pent-up demand. It's 2 years on from when we really got back in full as a corporation. This is people who have decided what's meaningful for them. How do I want to spend my life? And experiences are what they're looking for. Unforgettable memories and creation with friends and family. And that's exactly what cruising has to offer.
And that's what I sat down with the Accor CEO and he said, look, I haven't got enough hotel rooms and I haven't got enough high-end staff to help me run this business, which then takes me to the cruise is the high-end hotel, but to what extent are those packages off ship and onshore, those additional spends, are they critically important to the expansion and the turnaround from the loss that you've had? Do they add incrementally or significantly?
So, I mean, when we think about our business, we're a little bit different from when you're looking at hotel companies. I'm staying in a hotel in New York, and I won't tell you which one it is, but I'll tell you the service is not very good. And we've learned how to live with that as a society. It's almost a tacit acceptance. No, we should not. No. And the cruise industry, our brands did not deviate from service level. Our guests have high expectations, and we aim to exceed them. We do not close off floors. We do not shut areas down. We do not skimp on the services that we used to offer. It is full steam ahead, and that's what people expect, and that's what they're willing to pay for, and that's what we're seeing.
And let's talk a little bit about the fact that you are a global brand, of course, a global company that goes many places in the world. I don't need to tell you that the geopolitical landscape, very fraught right now, 2 hot wars, and of course conflict in the Red Sea. Has that impacted at all where you can go? And are you seeing any inflationary pressures from some of the things that we're talking about here?
So the second question is no. We haven't seen anything of note. Obviously, we pay attention to crude prices, which is a good barometer of a lot of things. With respect to the impact on our business, we had about less than 1% of our business touching Israel in one way or another. Not necessarily home porting, but it might be one transit stop on a world cruise or something of that nature. We made changes some time ago. We actually don't have any ships transiting the Red Sea area for several months. And so obviously safety first, and we have mitigation plans should we need to adjust where those ships would be transiting. But as of now, we're in a watch and learn mode.
Let's also talk about your bond book, because it was interesting seeing just last week, actually, S&P coming out and upgrading Carnival, not quite back to investment grade territory, but you're getting closer.
2 notches higher.
2 notches higher. On earnings day, actually, you think back, and the chief financial officer of Carnival said that there's a real possibility that Carnival will come back to the debt markets in 2024. Where's your current thinking on that, and what would actually bring you back to the debt market?
Well, really, the only thing that would bring us back to the debt market, as far as we can see, is if there's opportunity to refinance on more favorable terms.
So lower rates.
Yeah, lower rates. We're not, or managing our maturities, but we're not looking to lever up. As a matter of fact, as you said in the intro, we've managed to cut down our debt load by about $5 billion so far. And we expect much more of that as we go forward. That's priority 1, 2, and 3 when it comes to our capital structure, delever.
Hey, one of the things, and it kind of ties together geopolitical, but also kind of, where you're thinking about growth. Saw a story, I think it was today or in the last 24 hours, that the first domestically built ship in China getting ready to hit the high seas. But it's a joint venture. You guys are involved in this. And I think about how important China is for you guys, but also geopolitically concerns about China, its ambitions with Taiwan, and whether or not there's going to be some problems there down the road.
Sure. Well, we're very happy for the folks at the China JV. We actually unwound the JV earlier this year.
You did?
We did. So we've been providing shipbuilding expertise support for them, and we were very happy to do that. And we're
The
very
story
excited
still
for
says
them.
you guys are involved, but go ahead.
Well, that could be how we're involved at this point. But from our perspective, we got a portfolio of world-class brands all over the world, and that's where our focus is. You know, it's great for the cruise industry that China has opened up, and it will be opening up for international cruise companies. We're not going to be one of them that's going back in. We've got our assets where we want them. We've changed our asset strategy. We've moved ships to different brands to accommodate the change in China, and they're doing very, very well. So we'll take a wait and see approach on that as well.
But not a market you need to be in right now, just
No,
quickly.
it's definitely not.
All right, going to leave it there. Listen, so appreciate it. We know you're spending some time with family, but great to get you while you're in time.
My pleasure. Thanks, and Happy New Year.
Yeah,
I
same
hope
to
the New
you.
York hotel tuned in. Listening. You should be getting an upgrade.
I've had the same experience in some hotels. I don't think they have the workers.
They do not.
You gotta
Do you have all the workers that you need?
We do have all the workers that we need, and I'd encourage everybody, come book a cruise before we run out of inventory for 2024 because it's going pretty fast.
Josh Weinstein, the president and CEO of Carnival, thank you so much. So appreciate it.
Appreciate it.
Josh, thank you very much. Okay, it's the closing minutes of surveillance. Don't worry, you'll have everybody back to normal on Tuesday morning, but this is what we got for you. A fairly flat set of markets for you at the moment. You can still keep equity markets on the up with higher rates, according to Nancy Tengler. There you go. A little bit of green. You got S&P 500, 47.86. We never made it to the highlights of 47.96.5.
Few hours to go. Few hours to go.
Yeah.
Carnival shares are up 1%.
There you go. And,
Just let you know.
and a solid outperformance to the index, run by the man himself to my left, Josh. We've got 110.67. Will the dollar have another tortured year in 2020?
Happy almost New Year. Really fun to spend the mornings with both of you
Lovely to be with you
guys.
both. You out-glamorize me. There you go.
Stop.
Coming up on Bloomberg TV at 11 a.m., Torsten Slok, the chief economist at Apollo, not in an elf costume.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will
this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good Friday morning from the Bloomberg radio studio in New York City to our worldwide audience. Paul Sweeney and Kaylee Lines, we are with you today. We're simulcasting once again on Bloomberg Radio and TV, looking at the markets here on this last trading day of the year, just up fractionally. S&P up a couple of points there. Stocks, you know, just a little bit higher here. Yields slightly higher. 10-year Treasury, that's yielding about 3.86% on the commodities front. WTI crude oil just a little bit higher, just above $72 a barrel there. And gold, it's lower. Let's call it, where were we? $2,063 per ounce. Coming up, we're going to get the latest reporting on the tensions in the Red Sea and the impact on global oil. Plus, we're going to get the market call from Catherine Avery, President and CEO of Catherine Avery Investment Management. But first, let's get a look under the hood here and see what's happening in those markets. We welcome Abigail Doolittle. She covers all the markets for Bloomberg. Abigail, what are you looking at?
Well, I'm looking at the year that was, and I was thinking about all these different ways that we could characterize it, but I think that one way would be the year of surprises. If we were sitting here at this time last year, the mood was pretty dour. At the other hand, a Santa Claus rally, the last 5 days of the old year, the first 2 days of the new year, had started to develop. So in some ways, the big rally that we've seen shouldn't be surprising. One thing that might be surprising, though, stocks and bonds rallied together. I won't call it the everything rally, though. I've been hearing that a lot recently, only because commodities overall down more than 10% or thereabouts. The dollar down as well. But stocks, I mean, what a rally. The NASDAQ 100 up 54%, heading to its best year since 1999. The S&P 500 up 25%. The SOX up 66%, the best year since 2009. And even the Russell 2000, which at some point, not so long ago, was down on the year, finishing up a healthy greater than 15%. The transport's up 20%. Two indexes that I was able to find that are down. The KBW Bank Index minus 4.2% or thereabouts. And then this is interesting. The NASDAQ Golden Dragon Tech Index down 3.5%, down for a third year in a row. At some point, it's going to be interesting to see whether or not China can participate in this global rally for stocks, or at least this year.
Kaylee, I'm sorry to interrupt. You got to see Abigail's securities monitor. She must have like 5,000 things on her.
5 days back on the street.
Monitor. I mean, she has everything. No wonder she sounds so smart on these markets all the time. She's got everything in front of her.
No, well, thank you. I appreciate that. I don't feel that way often. The truth of the matter is I have to clean this thing out. Like, I'm trying to declutter for the new year. There's so much on there. I mean, for a while, like a couple of years after the fact, what stocks were, and that was it Panera Bread, like no longer, is that, but the old tickers would be there for like 2 years later, and then I'd find, so I have to do that right now, but thank you.
You know, we call it Panera, but actually in St. Louis, where Panera started, it's still the St. Louis Bread Company.
Really? I like
fun
that
fact
better.
for your,
that is a fun fact
for your Friday. Abigail, you were just talking about China and how a lot of people got the China call wrong this year, in that everybody expected it was going to be this big rebound story. The consumer in China was going to be unleashed, and that is something that didn't actually materialize. Just like real downside for stocks didn't actually materialize. A lot of people got that call wrong too. But when we look at the rally we have seen, and knowing that you don't just have a wonderful securities monitor, you also so closely pay attention to the technicals. Do you see signs of overextension here?
There's certainly signs of overextension in terms of the indexes having been overbought and then coming back down above the moving day averages. Just in terms of the NASDAQ 100 itself, up 54%, again, the best year since 1999. Now, correlation, of course, doesn't mean causation, but history does have a way of rhyming. So it suggests the NASDAQ 100, at least from a froth, a sentiment, an animal spirit standpoint, could be a little bit overdone. The big question is whether or not being overdone and needing to consolidate a little bit turns into the correction. Now, something I would point out is commodities down on the year. Mike McGlone and Vincent Piazza here, or was it Mike Piazza? No, that was the former Met that I used to watch. Vincent Piazza here at Bloomberg. They've both noted that commodities down on the year, that could be a little bit of a sign of economic weakness next year. So because the rally has been so impressive, this was the year inflation was tame, the year the economy stayed strong, the consumer stayed strong, the year of a Fed pivot that has helped stocks. But if that does come true in some way, that there is some sort of dearth of global demand for commodities, and that signals some sort of a recession ahead, next year could be a little bit surprising. Will that mean that this current overextension turns into an all-out correction? Technically, it's hard to say, but I will say that this last Fed pivot rally, tactically, this market was working pretty well from a technical standpoint, and then that's the one that went the other way. What we need to see is resistance, the all-time highs, and of course the S&P 500 trying to follow the NASDAQ 100 clearly taken out. Or if we go back down into the range, it could be a little bit of a cliffhanger.
All right, Abigail Doolittle, as always, smart on all things markets, monitoring all of the securities. Thank you so much for joining us. We want to get more on these markets now. I'm pleased to say Catherine Avery, Investment Management President and CEO, is with us now. So, Catherine, I'm sure you just heard everything Abigail was running through, how far this market has come, potentially where it could go next. What's your base case for 2024?
Well, 2023 has been quite the year. And we're expecting that 2024 is overall going to be a pretty good year for the markets. We're not seeing a recession next year. Inflation is going to be tame. And at the same time, you have an accommodative Fed. You have EPS, earnings per share, moving up around 11% for next year. That earnings recession is finally over. It's a presidential election year. And most importantly, remember, we had about $1 trillion that left the market and went into money market funds in 2023. And we're finally starting to see some of that money come out of money market funds and back into the market again, which is helping to fuel some of the advancement that we've seen so far this month. So look, the market's got the wind at its back for 2024. I think it's going to be a matter of how you position yourself.
So, Catherine, it seems like this great year-end rally that we've experienced really since kind of the third or fourth week of October, due in large part to that Fed pivot here. So a lot of folks are asking the question, have we gotten a little too far over our skis? Have we maybe pulled forward a little bit of the outperformance from 24 into this here fourth quarter? How do you feel about that?
Yeah, I mean, quite possibly, Paul. The market right now is trading at a forward multiple of about, about 22 times right now. So we've certainly gotten into a somewhat overbought situation. But remember, markets can become overbought and stay overbought for quite some time. So I'm not quite sure that the euphoria that we've seen so far has really settled down yet. And, as we come into next year, we are going to see more of a broadening out into those sectors that really didn't participate as much in 2023. You have the energy and the healthcare sectors, which has some pretty decent earnings growth for next year. You're going to have a bit of reversion to the mean. We're starting to see some of those names have an expansion in December so far. It's going to be a lot about looking at staple tech versus mega tech, looking at companies that have attractive valuations, robust cash flows, giving back to investors, and looking at sectors like the industrials versus the consumer. You've got government spending, you've got CapEx, you've got a defense sector that's starting to run quite low. So there's some wind at the back for the industrial sector as well.
Well, Catherine, if we could dig more into the tech sector specifically, given how much, the extent to which it led the charge for a great portion of this year, I feel like there's two arguments for tech, two different sides of this equation. On the one hand, if you think it's going to be a soft landing, maybe you don't need the defensiveness that technology has become. On the other hand, if the landing is soft, the Fed is cutting rates, borrowing costs are going down, it can support some of those richer valuations. So how does that work out for tech going forward?
Well, look, tech is here to stay. It's pretty much a staple in all of our lives. We can't live without it. But certainly a lot of the mega cap tech names have run so much this year that you're looking at valuations for on average in the high 30s. I think they're getting a little bit tired. So it's time to start broadening out a little bit, looking to those names that are going to participate in the upcoming trends in tech, like the AI. But they sit out on the fringes. They're part of the widgets that make the AI work. You know, software, things like data centers, the IBMs of the world, the Broadcoms of the world, Oracle, names that can support the technology, but we're not worried about them being so overbought because of their valuations.
Hey, Catherine, I like to think that earnings still matter here. It's not just the Federal Reserve driving this market. And look at on the Bloomberg terminal, looks like analysts are looking for about, I don't know, 12% earnings growth in 2024. Does that seem reasonable to you, or do you think there might be some earnings risk that investors need to be wary of?
Yeah, I think it can be. I think probably a lot of what we're going to see in 2024 is that we're going to see a decrease in the cost pressures that a lot of companies had faced in 2022 and 2023. So you're certainly going to see some bottom line expansion, top line expansion. That may be a place where it's pretty tricky for the earnings. But you still have a lot of productivity enhancements that these companies can take advantage of.
So all of that is in the equity market, Catherine. If we look at other classes, asset classes, where are you seeing opportunity? What about fixed income? What about in foreign exchange, given that the base case for a lot of people next year seems to be a weaker dollar?
Yeah, well, certainly the weaker dollar. And I think commodities as well. As you mentioned before, commodities haven't really participated in 2023. But in 2024, at these levels, I think that we're going to start to see more people come into these markets.
So, Catherine, it's interesting here as we think about these markets, and you talk to your clients here. I mean, what are you trying to tell them about kind of the next couple of 3 years? Because, boy, if I think of just a little bit longer term, I have to be overweight tech, as you say, maybe healthcare, as you say. I don't feel the need to be defensive, but I know, in the short term, a lot of folks are still saying you need to be defensive.
Well, it depends what you mean by defensive. If you mean by keeping all your money into fixed income, I'm not sure that that's a great long-term move for your money. What we're telling clients is that if you need money for the next 1 to 3 years, certainly keep that on the sidelines. Keep it into fixed income instruments, anywhere from 1 to 3 years in terms of maturity, and keep that protected. But then go out on the curve. I mean, we're looking for markets in the next couple of years to look into more normalized returns. That means anywhere between 7 to 10%. Not the growth that we've seen in markets where we're having 25%, 20% markets, because we're not going to go back to that zero interest rate environment. But you're still going to need to have some of your money into the market. You don't want to become too defensive, because you're going to have some inflation protection for your money.
Catherine, you say we're never going back to that zero interest rate environment. Where do you think ultimately we end up settling out? Everybody's talking about the Fed cutting, okay, sure, up to 150 basis points next year, but do they stop there because the new R-star is maybe higher?
Yeah, I think longer term we're probably in that 2 to 3% range.
All right, I can live with a 2 to 3%. I'm looking at the 10-year on a max here. Right. That wouldn't be so bad. Catherine Avery, thank you so much for joining us. Catherine Avery, she is the CEO, and she is the president of Catherine Avery Investment Management, joining us via Zoom from Sarasota, Florida. That sounds pretty good this time of year, Sarasota. But again, looking at the 10-year Treasury, I mean, it's tough to get it because it really spiked there in the 80s. But boy, we're still relatively low interest rates right here on it. And when you take a look at it, and you look at on the long-term basis. So I think, it seems like a lot of folks feel comfortable with this kind of leverage. I'm looking at the 30-year contract mortgage, 6.83%. That's the MBA 30-year fixed. So that's better than close to 8%, yes. But boy, that's a lot higher than Matt Miller's 3.25%.
Absolutely, and it probably is still a bit too high for it to really unlock the housing market and the choke points we have seen with people not being willing to let go to put their existing homes on the market because they want to keep their low mortgage rate. So where's that equilibrium, Paul? I think we all have yet to find out.
Yep, absolutely. Coming up, former President Trump will file a legal objection after Maine bars him from the primary ballot. We'll have the latest. Again, looking at these markets, really pretty much unchanged across the board in terms of the main equity indexes today. Really no movement here. Yields just slightly higher, 3.87% on your 10-year U.S. Treasury. We'll have more coming up. This is Bloomberg.
Where do you think the future of technology is going in Silicon Valley and elsewhere over the next 5 or 10 years?
Technology is an underpinning. It's not its own industry. It is a part of every industry, and it's actually going to increase productivity and actually make our lives better.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Markets. I'm Kaylee Lyons alongside Paul Sweeney today as we simulcast on Bloomberg Television and Radio live from Bloomberg's radio studio in New York City, in New York State. But news from the states today really centers around Maine, or perhaps yesterday, when Secretary of State there, Shana Bellows, ruled that Donald Trump cannot be on the ballot in the state's Republican primary election. Like the Colorado State Supreme Court, before this decision, it all centers around the 14th Amendment, which bars anyone from holding public office who has engaged in insurrection or rebellion. Bellows wrote in her decision, this is a quote, "I do not reach this conclusion lightly. Democracy is sacred. I am mindful that no presidential candidate has ever before engaged in insurrection." Now, the Trump campaign is vowing to challenge this decision. So let's get more on where this goes next. Joining us now from Washington is Jordan Fabian, who covers the White House and those attempting to seek the White House for us here at Bloomberg. So, Jordan, where does this go next?
All signs, Kaylee, is that this is going to the Supreme Court, just like the case in Colorado, where the Supreme Court in that state kept Donald Trump off the ballot. This is going to cause a lot of havoc and chaos in the lead up to the primaries. The states are going to want certainty, legal certainty, on whether Donald Trump can be excluded from a primary and general election ballots. So there's going to be a lot of pressure on the Supreme Court to have a quick ruling here as we go forward, because the primaries are starting in just a couple of weeks, and the state and local officials are going to want clarity.
So, Jordan, what have we heard, if anything, from the Supreme Court about their willingness or to hear this case and the timing, perhaps?
We haven't heard anything yet, Paul, about whether they will take up this case. The Colorado case would be the first up. The Colorado Republican Party has already appealed to the Supreme Court, but we could hear pretty soon in the new year whether they decide, the justices that is, to take this up.
Well, and in the meantime, while we await an actual decision out of the highest court in the land, the Trump campaign and the former president himself obviously are very vocal about what's happening here alongside the other many indictments the former president has come under. He says this is election interference, that he's being persecuted politically. Does this just have the effect of all of those other legal issues we've seen before, Jordan, of just galvanizing his base and actually making him stronger in the Republican primary race?
It very well could do that. You raise a great point, Kaylee, which is after each of these indictments, whether it's January 6th, whether it's the classified documents, whether it's his business fraud trial, the Republican voters have rallied around him. And not to mention his own opponents have come to his defense. You've heard Ron DeSantis, Nikki Haley say in this instance with the ballot challenges that they would beat him fair and square. They don't want the courts to decide whether they're running against Donald Trump. But that all has the net effect of making these legal issues into a net positive for Donald Trump with Republican voters. Now, whether that's the case with general election voters, whether they're going to see all this legal chaos surrounding Trump and want to hand him a second term in the White House, I have my doubts about that. But in the Republican primary, it's certainly helping him.
Jordan, has any consensus emerged among legal scholars as to what the law is here and how it should be applied?
No, Paul, there's a lot of disagreement around this issue, and it centers around Section 3 of the 14th Amendment, which says those who engaged in insurrection should not run for office, should not be allowed to run for office. And there's disagreement about whether a court needs to find that person guilty of a crime, or if it is just they did the conduct and therefore they're banned. But there's a question on who gets to decide whether a person engaged in that conduct. In Maine, we saw the Secretary of State who controls the election process there make the decision. In Colorado, we saw the state Supreme Court, so the judicial branch in that state made the decision. So one thing the Supreme Court could look at is who gets to make that decision, whether someone engaged in insurrection and is therefore ineligible to run for office.
Yeah, it's interesting that the judicial branch, which is supposed to act as a check and balance to the other branches, could play such a pivotal role in deciding who gets to helm the executive branch of the government, Jordan. And on that note, what have we heard from the Biden White House about this, knowing that often Trump tries to cast Biden's DOJ as something that is actively working against him? Are they trying to distance themselves from this issue as well, or trying to seize on this as a me versus him kind of narrative?
Well, the White House staff has said very little about this. They are cautious about wanting to comment on legal matters. But the president himself has actually commented on this a couple of times. He was asked on a trip I took with him a couple weeks ago to Wisconsin about the Colorado case. And he said, look, the whole question of the 14th Amendment is for the courts to decide. But is the question, did Donald Trump engage in insurrection? And his view is yes, that Donald Trump did do that he is responsible for all of the chaos and the violence on January 6th. So, the president has put that out there. And it's not surprising because President Biden is going to want to put these issues of democracy and the threat that he says Trump poses to it at the center of his reelection campaign. So, again, it's not surprising for the president to weigh in on it, but it is surprising from the perspective of these are ongoing legal matters, and the White House is usually cautious about talking about those.
All right, Jordan, thank you so much for your reporting. We appreciate it. Jordan Fabian, he's a White House reporter for Bloomberg News. He's based in Washington, D.C. Let's shift gears here. A lot of folks are flying all over the place during this holiday season. And there's a story out there that Bloomberg's been following very closely about fake parts within airplanes, which sounds like a big deal to me. I think I want the real things in the airplanes I'm flying. Kate Duffy joins us. She covers UK aerospace for Bloomberg News. She's based in London. Kate, what's the latest here? Fake parts, could you give us the background here?
Yeah, so the last big update on this situation was in early December, and that was when the Serious Fraud Office announced that they had raided an address and arrested an individual in relation to AOG Technics. So this is a London-based firm that's been accused of supplying fake airline parts, aircraft parts. So that's bogus certification in the UK and 2 other countries across the world. So an investigation was launched into this company's supply of plane parts. And what we're seeing now is that the industry is grappling with the task of adapting paperwork for millions and hundreds of millions of components for aircraft into digital documents instead, and so simplifying the process. But this structural reform could take years, and it is of growing importance because, as we've seen recently over the past 6 months and what Bloomberg has been reporting on, it is a significant issue.
Well, and what's so surprising about this, Kate, is this is 2023. Almost everything is digitized. Just slap an air tag on these things, or you'd think there would be an easy way to do this, especially for an industry that prioritizes safety to such a degree. So what's the hurdle here?
Yeah, so at the moment, you're right, there is no central electronic database for components, and this means that aircraft parts don't have traceability as the system is paper-based. So this makes it more complicated, and the fact that these aircraft parts are produced in bulk, and there's so many around the world, is going to take ages to sort of trace these different parts and put them in one digital system. So for the time being, airlines are reviewing their fleets for these potentially bogus parts, and we're all waiting to see what could happen.
Kate, who's responsible for, I guess, updating this system here as it relates to digitizing all these parts? Is it the airlines? Who's responsible?
Well, there's parts distributors. There are also airlines, but there's different companies and parts that come into this. Regulators are involved as well. So it's not even just, one person that should be doing this. I think this is a worldwide thing, and people need to come together because airline manufacturers, they're selling, aircrafts to different companies across the world. So it just makes it more complicated.
All right, complicated indeed, although you'd think there should be an easy way to do this in the 21st century. Kate Duffy, thank you so much for your great reporting on this. And Paul, I feel like a lot of people just assume the planes they're getting on are safe, and where the parts came from, that they work.
Exactly, especially from Western airlines, you kind of assume it. Now, some other parts of the world, you can't make that assumption. But maybe that assumption really wasn't valid overall.
Yeah, all right. Well, we're going to go from air transport to sea transport coming up next. Get the latest on what's happening in the Red Sea, disruptions to trade there, and what all of it means for energy. Rebecca Babin of CIBC Private Wealth Group is joining us next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Markets, simulcast today on both Bloomberg Television and Radio. I'm Kaylee Lines alongside Paul Sweeney as we're closing out the year of 2023 for financial markets. It has been a wild one, to say the least. Many things that we didn't see coming, including the eruption of conflict in the Middle East and disruptions we are currently seeing to trade in the Red Sea and Suez Canal as a result of some of these issues. We want to go now to Brendan Murray, our trade czar here at Bloomberg News, for the latest on what's happening in that region. So, Brendan, we know that many ships are now avoiding the Red Sea entirely, going the long way around the coast of Africa, adding to the time of their journeys. Are there any signs that things are normalizing at all, or instead is it going the other way?
It looks like the situation has stabilized, and really it's a confidence game at this stage. The U.S. government, the military is trying to reassure the shipping companies that they'll be secure. Those ships are safe if they move through this section of the Red Sea where the attacks have been taking place. But it's still way more the exception, the ships, container ships moving through this area than the rule. Hundreds more, as you mentioned, are going around, taking a long way around Africa. So I just using the MapGo function on the Bloomberg terminal, I can see 10 to 15 container ships, Maersk, MSC, the French company CMA, CGM, are it appears moving some of their larger ships through the region, but taking it on a case-by-case basis, apparently.
Yeah, I'm using the MapGo function as well, Brendan. It's one of the great functions on the terminal for so many different uses here. And I do see some ships kind of making their way through here. I guess the question is, do we have any sense that the U.S. military presence there is in fact having a calming effect on some of the activity there?
Well, they are putting out regular press releases, statements on Twitter and whatnot, saying that they shot down a drone in this area, or intercepted a missile over here. So the attacks are happening, and the defense system that the U.S.-led coalition is setting up is having some successes, but until that becomes an offensive, that's more of an offensive posture, I'm not sure that the giant ships moving at slow speed, easy targets, are going to feel very confident moving through these waters if drones are still being launched from Yemen.
So obviously, Brendan, it is a question of when people or companies will feel secure enough in making these decisions. Where do we expect the real messaging is going to come from on this? Is this really just the U.S. that will say, we can guarantee the safety? Is it from this kind of coalition who speaks for that coalition? Is it others in the region, Saudi Arabia? Who's leading this right now?
Yeah, it sounds to me like the shipping industry is trying to have its voice heard more and more, and that would be through the governments where these companies are based. Maersk is in Denmark, Hapag-Lloyd is in Germany, CMA CGM in France. So you would think that the European Union is trying to put the pressure on the military forces that are in the region to secure these ship or do it themselves if possible. So it's the industry speaking through its governments to try to put the pressure on and get this passage secured so trade can flow smoothly again.
Brendan, are you hearing anybody, whether it's a shipping company, a shipper, or maybe even just an economist looking at this and saying, hey, this is going to have an impact on the local economy, maybe the broader European economy, or is it just, are we too early in this whole process?
Well, Bloomberg Economics at this stage thinks that this will have a limited economic effect broadly. Shipping costs are a relatively tiny portion of the overall cost of a consumer good. They were going to have to spike a lot higher than they are now for that, for that to feed through to inflation. So at this stage, we're only 10 days, 2 weeks into this. If it's resolved in less time than that, then we're looking at sort of a blip on the economic spectrum. But if this drags on for weeks or even months, we could see the shipping rates continue to rise, and that could take a bite out of producer prices and consumer prices.
All right, Brendan, thanks so much for your reporting. We really appreciate it. Brendan Murray, he's the trade czar, Bloomberg News. He is just courageously manning the Queen Victoria Street London headquarters for Bloomberg here on this Friday before New Year's. The impact on global trade, well, one of the areas that a lot of folks think we will see it will be in global oil. I'm looking at the WTI crude oil here. It's up just fractionally today, just under $72 a barrel. Rebecca Babin joins us, senior energy trader at CIBC Private Wealth Group. So, Rebecca, we've seen oil kind of ping all up and down here over the last several weeks here on some of this geopolitical news, first out of Ukraine, of course, over the last year, now out of the Middle East here. What are oil traders telling you here about what's going on with the price of global oil?
So I think crude traders are telling you two things. First, they don't chase geopolitical-led rallies with the backdrop of softening fundamentals, which is exactly where we are right now. We're looking at a supply situation where there is plenty of crude oil available in the world. In fact, we have OPEC Plus who has pulled millions of barrels from the market in order to keep prices stable. So it's less about, for traders, is there a barrel available? And more about, okay, how long does it take for that barrel to get where it needs to go? And how much does it cost? And they've kind of come to this conclusion that it probably adds a couple bucks to the cost and time to get the barrel where it needs to go. But at the end of the day, the barrel is there. And when we look at 2024, crude traders are looking at the supply and demand imbalance and looking at a market that is slightly oversupplied to very finely balanced, even with OPEC cuts staying in place. And that assumes OPEC Plus members can comply. And there's some question around that as we've seen some friction within the group. So I think the crude market right now is less concerned about, is the barrel there, and looking at, okay, how long does it take? Does it have a cost? And guess what? 2024 doesn't look to be this gangbusters year of demand growth like we saw in 2023. So they're kind of saying, I'm not really willing to chase any of these rallies. I'm more likely to take profits. And a lot of that is reflected in positioning, which remains very, very, very low from a net length perspective.
So, Rebecca, if a lot of this is really driven by concern about supply being too plentiful, even at a time when OPEC has been really trying to restrain supply, something we've learned in 2023 that the power of OPEC as a price setter essentially is waning because you're just getting too much production from countries that aren't in the cartel?
I think we learned that as soon as you think that U.S. production is not going to respond to price increases and that they can be controlled, you are wrong. And OPEC has learned this lesson very, very clearly this year. There was this expectation that U.S. supply growth, even if prices were high, was going to be kind of that 600,000-700,000 barrels of supply growth. Guess what? It came in at closer to 900,000, 1 million barrels of supply growth. And every time OPEC dug that deficit, supply was there to fill it, whether it was the U.S. Also, Iran was a big part of that, as well as Brazil. So I think OPEC is going to have to realize that their ability to stabilize the market is there if they continue to remain disciplined, but it's going to take so much longer than maybe they anticipated. And that's going to take a lot of negotiation from the OPEC plus groups to keep members happy. And that OPEC put, which supported the market when demand softened, is maybe shifted down from 70 in WTI to maybe 65. And so I think that's the recalibration we're under. I actually do think the market is kind of looking at everything through this bearish lens at the moment. And when we could actually see the market perform better than expected, just because everyone is thinking the worst is to come. They think OPEC isn't going to be able to hold it together. They think U.S. supply is going to outperform the way it did in 2023, and that, demand growth is going to really massively underperform because of China. And whenever I see the market really just focused on one side of the equation, I start to say, okay, what could go right? Everyone's looking at what could go wrong. There are a couple things that could go right. So I actually think the market is set for a little bit of a rebound. But at this point, that's what traders are focused on.
And Rebecca, you mentioned China, and that's kind of where I wanted to go here. The market, I guess the softest kind of oil market, global energy markets, tell me that market doesn't think China's going to come roaring back in 2024. What's kind of when you talk to traders on the street, what's kind of the call on China?
So next year, we're expecting demand growth globally to be around 1.4 million barrels a day, which is still good. China makes up a good slug of that, 600,000 to 800,000 barrels. So China really is critical for us meeting that demand growth number. Most of that is coming from continuation of jet fuel. That's the area where there's still room for the pent-up demand to flow through, particularly in international jet. So those are the numbers that people are watching, but you're dead on. Everyone's looking at the headline macroeconomic numbers coming out of China and saying, you know what? This isn't going as a kind of what we planned, and that number's in question. So I think if you see demand numbers start to get ratcheted down, it's going to be from China, and I think that's what people are most focused on. I tend to think, again, the market is already ahead of where the analysts are in terms of ratcheting down that demand growth in China. Maybe the analysts haven't updated their numbers, but the market is already saying, I'm not sure that they're going to be able to meet that. So I think the expectation is already there. But obviously, China remains one of the most critical data points we're going to see in 2024 for the crude market as it was in 2023.
So when we think about China and how the story there has not materialized in the way that many people thought it would this year, despite relatively supportive policies coming on both the monetary and fiscal side from China at a time where here in the U.S. policy has definitely not been supportive, and yet it's kind of been firing on all cylinders to this point. When we think about how policy could change going forward, the idea that if we're having a Federal Reserve that is cutting rates and what that leads to is a weaker dollar, how do you expect that to filter back into prices for oil and I guess commodities more broadly?
Well, the weaker dollar typically should be very bullish for crude oil, and it's been weak, and we haven't seen that relationship play out so far. Like many things that we thought would happen in 2023, that weaker dollar story hasn't actually helped crude all that much. I think it helps much more in 2024 when we come back to this more normalized economy after this kind of COVID reemergence trade has played out in 2023. I think it absolutely should help demand in any emerging market country that's buying crude oil in dollars. If you get that weaker dollar, that is going to lower your cost, and that is going to help spur some additional demand. It hasn't played out as we would have expected in 2023, but I think some of those more traditional relationships will come back in 2024, and the dollar should be a tailwind for crude.
Rebecca, quickly, where's Russian oil going? Is it getting onto the global market?
It absolutely is. And One really interesting thing when we talk about the Red Sea, almost half of the crude oil flows that go through the Red Sea are Russian flows to India and China. So when we talk about rerouting all of that trade, I actually think Russian barrels will continue to move through the Red Sea. They're not necessarily a target of the Houthis. They're going to be willing to take that additional risk that other shippers might not. So all in all, Russian crude is readily available and on the market. It's making its way to India and China. That has rerouted some of the Saudi Arabian crude to Europe to fill that gap. So the market has been so efficient at being able to handle disruptions and finding a way to get the crude where it needs to go. And I think that continues to happen. I think that's part of the reason why the events in the Red Sea haven't had as a dramatic of an impact as it might have looked like it would on a headline level.
All right, Rebecca Babin of CIBC Private Wealth Group, thank you so much for joining us. And of course, as we talk about oil prices and how they have been relatively more depressed, prices at the gas pump have been lowered, maybe that's what's powering the consumer to keep spending money on other things like this holiday season. So we're going to get more on a read on the consumer, how they've been grappling with inflation to this point, and what's ahead in 2024. How much can that spending power really keep firing? William Blair's Sharon Zakvia is going to join us next with a look at that sector, restaurants in particular. This is the last trading day, of course, of the year. Stocks have taken a leg lower. We're now down by about 0.3 on the NASDAQ 100. So stick with us. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All right, one of my favorite functions on the Bloomberg terminal is Rich Go. It is a definitive analysis of the personal wealth of some of the wealthiest people in the world. Elon Musk tops the list, no surprise there, $232 billion. And the number I like is what happened this year? Well, he gained $95.4 billion in net worth, so good year to be Elon Musk. And we track this stuff. Christine Alrim joins us from Bloomberg News. Christine, Elon Musk back on top firmly in first place.
That's right. It feels like a long time ago at the beginning of 2023 when Musk was actually not in the number one place on our list of the 500 people in the world. He was in second place at the beginning of this year after Bernard Arnault, the CEO of French luxury brand LVMH. And that was because of the tech rout in 2022. It hit most tech billionaires pretty hard and really changed the composition of the index. But what we saw this year was a rebound in tech stocks, got those tech billionaires back on top, including Elon Musk back in the number one spot. And in total, $1.5 trillion was added to the 500 richest people's net worth this year. About $650 billion of that was for tech billionaires alone. So it really shows how much the resurgence in tech stocks and the NASDAQ has helped those billionaires regain their status as the people in the world.
Yeah, tech billionaires, according to this story, saw their wealth grow by 48%, so even outpacing the gains a lot of others saw in their wealth, I'm sure, looking at their 401ks and other investments, et cetera, this year. So if it was a story of the tech billionaires in 2023, who's going to be the ones to watch in 2024? Is it these same individuals, or are there new ones we should be keeping an eye on?
Yeah, that's a great question. I mean, Musk obviously is always going to be someone to watch. I think that's a safe bet, but it's really hard to say for sure. I mean, I don't think anyone would have foreseen the way that this year played out if you had asked them 1 year ago today. I think there were still fears of a looming recession, fears about how rising interest rates and inflation were going to work their way through the economy. Obviously, a lot of geopolitical factors that came into play this year. No one would have foreseen that essentially these billionaires have added as much wealth in 2023 as they lost in 2022. So it's almost like 2022 didn't happen. Looking ahead to next year, obviously it's hard to say for sure what's going to happen, but there are some key names we know are going to be interesting to watch. A couple of women. Number one that I would put on the list is Françoise Bettencourt-Meyers. She's the heir to the L'Oreal fortune, and she just became the first woman to hit $100 billion in net worth yesterday. So that's a major milestone for the index. We've never seen a woman with a 12-figure fortune before. She has been the beneficiary of L'Oreal stock hitting record high after record high this year, even though luxury stocks as a whole have struggled a little bit, partly because of a slowdown in consumer spending. Chinese economy hasn't been as strong as hoped. L'Oreal has kind of bucked that trend. They have geographic diversity, they have product diversity. That's really helped their shares, and that's helped her net worth as well. Another woman to watch this year is Miriam Adelson. She is the largest shareholder in Las Vegas Sands after her husband Sheldon died in 2021. She just bought a majority stake in the Dallas Mavericks. She's becoming the first woman to own the majority of a major sports team. That deal is actually expected to close very shortly. She bought that from Mark Cuban for $3.5 billion, and is clearly kind of ramping up her public profile as someone who had previously stayed relatively quiet.
All right, really fascinating individuals to watch as we go forward into 2024. Must be nice.
Yes.
Must be
Must
nice.
be nice.
Bloomberg's Christine Alram, thank you very much. And make sure to check out that story on the terminal to get a real look at the kind of numbers we are talking about. These are some very, very rich people. Now, Christine was just talking there about how some of these names to watch include the likes of the heirs of luxury companies, LVMH and the like, and that gets us to a conversation around the consumer, not necessarily just when it comes to the luxury story and the retail story, but other sectors as well, like, say, restaurants, for example. So on that note, we want to bring in now Sharon Zakfia. She is William Blair Equity Research Group Head of the consumer sector. Sharon, thanks so much for joining. If you look at the performance of restaurants this year, it wasn't too bad. It was positive, gained about 12%, but underperformed the broader market as a whole. Is that going to improve in 2024? What's your broad outlook like?
Yeah, I think the restaurant space is really well positioned for next year. I think we're seeing very resilient sales trends, which is encouraging. You know, over the past few quarters, the consumer seems to be really preferring experiential spend. Restaurants fit in that bucket. If you look at the last 12 months, restaurants lead all retail sectors in terms of growth. And we've already seen multiples kind of contract and normalize. So I think that positions the sector really well for next year. We have a tendency to prefer limited service restaurants because that tends to be where all of the share shift has been going over the last 20 years. But even within that framework, I think casual dining can also do well.
Yeah, that's kind of where I want to go, because we are seeing the consumer weakening a little bit, still strong, but still weakening. So are we seeing that in restaurant trends, where they're going, maybe trading down a little bit?
It's always hard to prove trade down versus trade out. I mean, we don't have great insight into the customers who don't show up. But what I can tell you is that limited service has been doing better. That has been the case, though, for much of the past 20 years. So it's hard to say that's trade down versus just normalcy. We also tend to like names that have good loyalty programs right now. That is really a lever that restaurants did not have in the Great Recession. So names like Chipotle, Starbucks have really robust loyalty programs. We think that is, a tool that can be used should the consumer soften further without resorting to material broad-based discounting.
Well, on that note, Sharon, if we are thinking about a consumer that maybe is softening, if not outright, stopping their spending, what does it mean for the pricing power of a lot of these restaurants, knowing the degree to which many have been able to exercise it and many who have struggled in that department as we've faced, over the last several years, higher input costs. How do you see the ability to continue passing that on going for these names?
Sure. And I think pricing power is an absolute necessity in the restaurant space. I mean, we saw unusual commodity inflation over the past few years. That's abated very quickly, but labor only goes in one direction. It only goes up. And this is a labor-intensive industry. So if you look at next year, we've seen commodities really roll over, as I just mentioned. Labor's become more benign, partly as a function of what the Fed's been doing. And so we saw pretty material restaurant margin expansion this year. Next year, I would expect more normalized pricing and more modest restaurant margin expansion. But nonetheless, we do expect margins to continue to go up in the restaurant space, and in many cases, achieve, all-time highs.
I'm looking at your coverage list here, Becca, and I don't see Cracker Barrel, my all-time favorite. So other than that, which I'm a huge Cracker Barrel fan, what's your top pick in the restaurant space these days?
Yeah, we really like Chipotle. I mean, it was a great name to own in 2023, but we think it has a lot of those aspects that we're looking at, right? Great loyalty program, over 30 million members. When we do surveys, it always ranks really high in perceived value. That should provide some cushion if the consumer softens. We've seen traffic trends at Chipotle stabilize to improve as this year's gone on. So we think there's really high visibility there on the sales trends. And, frankly, it's still a very growthy name, right? I mean, we think Chipotle can more than double the number of units they have in the U.S. over time. That should equate to a more than double in revenue. And with the drive-throughs, the Chipotlanes, that's also a positive to margins. So all of the arrows that we look at for Chipotle are pretty unilaterally positive.
All right, very good. Sharon, thanks so much for joining us. I could be a restaurant analyst because I go to a lot of restaurants. Sharon Zakvia, she does it for a living, though. William Blair Equity Research Group, head of the consumer sector. We're talking about restaurants today. She covers a lot of the consumer space. We're focusing on the restaurants here. And one of the key issues I remember from the pandemic was just labor. They couldn't get labor. Like even the Chipotle on 3rd Avenue here near our Bloomberg office, some days they just wouldn't open because they didn't have staff. And that seems, as Sharon was suggesting, that seems to have abated somewhat.
Yeah, but as she said, labor really only goes one direction.
Yep.
So how much are we still going to see continued tightness in the labor market, especially for service sector workers, where service sector inflation has been more sticky? I just want to know, Paul, where's the nearest Cracker Barrel?
All right, you go out on
Route. There's no way there's one in New York.
No, it's in Jersey. So from Summit, I hop on Route 78, go about 20 minutes west, and I run into one. And it's like 95% of all the Cracker Barrels in this country are within like a mile of an interstate.
Well,
it's a great strategy.
What do you order?
Country boy breakfast. Absolutely. Just loosen the belt and sit right down. That's how you do it. So that's good stuff. Went to my first Cracker Barrel in Tennessee, and they know how to do it right down there. So anyway, good stuff there. S&P 500 off 0.25%. This is Bloomberg.
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on, dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
The reception, the acceptance of Purasango has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purasango all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
All right, welcome back to Bloomberg Markets. Kaylee Lyons and Paul Sweeney. We are broadcasting live from the Bloomberg Radio studio. We're simulcasting on Bloomberg Radio and TV, so that's a cool thing here. Stocks trading a little bit lower here. S&P 500 off about 0.2%. The NASDAQ off about 0.5% on this last day of trading. You know, it feels like when the Fed made their pivot move weeks ago now, the whole market changed. Equity markets, fixed income markets, economic calls seemed to moderate as well. So we want to check in with somebody who really follows this stuff, who gets paid to be right on the economy. Torsten Slok, he's the chief economist at Apollo. He joins us via Zoom. Torsten, it felt like that soft landing discussion went from kind of the back burner right to the front burner, and that kind of feels like it's become the consensus view. Has the market gotten a little ahead of itself, do you think?
I do think it has, Paul. I mean, if you think about the market interpretation of what the Fed was trying to tell us, it's been very, very one-way, meaning that the market is clearly now, as you're saying, latching on to every indicator that suggests that we will have a soft landing. But there's still a number of risks to the dual mandate. There are both risks to inflation. There's also risks to growth. Most importantly, we're beginning to see now a nascent recovery in the housing market. Remember, housing makes up 40% of the CPI, and Case-Shiller earlier this week is now up 5% year over year. And over time, if we do get another boom in the housing market, if rates are going down, if the stock market continues to go up, if credit spreads are tightening, if mortgage rates continue to decline, mortgage rates now are at the lowest level since May, if that creates a boom in housing, that will certainly also create a booming inflation. So it is just premature to come to the conclusion that we can declare victory over inflation here.
Well, Torsten, it's interesting to hear you talk about potentially upside risks to inflation, because I feel like after the last few prints that we have seen, and when you look at, what PCE deflator, the Fed's preferred gauge, has done over the course of several months, when you average it out, people were actually talking about whether the Fed could end up undershooting the 2% target. You don't think there's a real risk of that?
And that's a good point, Kaylee, but I still think that the market is too focused suddenly on 3 month changes, 4 month changes, 2 month changes in inflation. Mm-hmm. Let's look at inflation the way that the Fed looks at inflation, namely the 12 months change. Ask the same people what they would have said like 6 months ago when the 3 months change was a lot higher than what it is today. It really is cherry picking to just look at 2, 3, 4 months changes, even 6 months changes in inflation. You have to look at the big picture, and a lot of the inflation indicators that the Fed creates, including at the Cleveland Fed, they still show that we are not out of the woods. Just look at core CPI. It is at 4.0, and 4.0 is not 2. So given 4 is not 2, that basically brings you to the conclusion that yes, it's moving in the right direction, but it is absolutely the case that it is just premature. And I think that's also what several FOMC members subsequently have come out and said. It's premature to say that we can declare victory over inflation here.
Torsten, we have several guests on the show who say the exact opposite. Most recently, Cam Harvey, finance professor at Duke University, said basically, and his theme has been, and others have said this basically, if you look at the real-time inflation data, not the backward-looking inflation data that the Fed uses, but real-time data, inflation's been whooped, and it has been for a while. And in fact, the Fed's been late to cut rates. How do you react to that?
Well, but taking aside all the arguments I just made for why you should look at it the way the Fed looks at it, let's just think about the argument that, inflation is falling a lot faster. Well, if inflation is falling a lot faster, the economy should also be falling a lot faster. Otherwise, why would inflation come down so quickly? And the conclusion, therefore, is, well, the economic indicators are not falling so quickly. If you look at the expectations, if I type ECO on my Bloomberg screen and I look at what our expectations to non-farm payrolls on Friday next week, it's 168,000. The unemployment rate is still 3.8. In other words, the economy is still doing okay. So the conclusion is that there is certainly a lot of improvements, and the low-hanging fruit have been picked in inflation by straightening out supply chains. But it is really true that the last mile is going to be the more difficult one, because now, again, we are now generating, with the Fed pivot, a boom in the housing market. And housing has a weight of 40% in the CPI basket. And if housing now is beginning to recover, which it is, then that will begin to put some upward pressure on inflation. And if something that weighs 40% in the CPI is going to move higher, that will certainly create some problem for the Fed, where the pendulum have to swing from the more dovish direction that they're in at the moment back to a more hawkish direction. So we have a bumpy road ahead of us when it comes to the Fed and what rates will be doing over the next several months.
Well, and Torsten, as we know, there's a big difference between stopping the hikes and starting the cuts, and there potentially could be a good deal of time in between. And this is something we've heard from the Fed as well, the idea that they haven't actually seen yet the full effects of their tightening hit the economy. And it's not exactly clear how that lagged effect works when everything kicks in. How are you thinking about it?
No, that's true, and that's a really good point, Kaylee. And I think that was why they did back off with saying no more rate hikes, and the next move likely will be a cut. But Jay Powell went out of his way, and likewise Alston Goldsby. We've had a number of FOMC members afterwards saying, hold on, let's just wait and see. We are not there yet. So I think that the main conclusion for markets here is that rates have gone down too much, both in the front end and in the long end, as a result of the Fed pivot. This is not what the Fed intended to communicate. The market may turn out to be right eventually, but we certainly also have some very strong arguments for why the market could be wrong and why inflation is not going to come down so quickly. So the debate is still out there. The jury is still out on this discussion, and it is not just a one-way street where we can now all say, well, inflation is no longer a problem, COVID is behind us, and therefore everything is fine. There's still a lot of bumps on this road ahead of us on the macro front.
Torsten, can you give us your thoughts on the labor market? That's been one of resilience all throughout the last several years here, and I'm not even sure what labor hoarding is. Some people say that's a contributor. Can you give us your read on the labor market today?
Yeah, so the unemployment rate surprisingly fell in November to 3.7 from 3.9 in October. And of course, non-farm payroll is 199,000. There were some issues with the UAW strike and the motion picture strike. But even if you're correct for that, you still had a reasonably solid 130, 140,000 jobs created in the month of November, with the consensus expecting that we will see roughly the same amount here in December. Then I do think that the labor market is still doing surprisingly well. And in some sense, to the debate we just had, this is actually telling you that maybe we are not quite out of the woods, because wage inflation, if you look at average hourly earnings, they're still growing at 4%. If you look at the NFIB, they have an indicator where they ask firms, are you planning to raise wages for your workers over the next 3 months? That has been moving up very quickly in the last 6 months. So there's a number of indicators that point in the direction of the Fed pivot, combined with the easing in financial conditions. It could create a renewed boom in the economy and therefore exactly complicate the last mile of getting inflation back to 2%. So the labor market still being tight is a double-edged sword. Of course, it's good that the labor market is still good, but it's actually not good for the Fed, because wage inflation is still significantly higher than where it has normally been when the Fed has had inflation at 2%. So a tight labor market is also something that the Fed needs to work with when they need to get to the goal of getting inflation back to 2%. So yes, things are still fine in the labor market, but the key question again is going into 2024, can we get inflation down to 2%, or does it require that we get a lot of more bumps on the road? And I do think the pendulum will have to swing back in a more hawkish direction for the Fed. And therefore, for equities and for credit spreads, we have a more rough road ahead relative to how markets are pricing at the moment.
Well, Torsten, I feel like this is the debate we've been having, if not for this entire tightening cycle, at least the latter portion of it, the idea of, does the Fed need to cause a recession? Does the Fed need to break the labor market in order to actually get the job done? Do you think time will prove out that actually the answer to that may have been yes?
Absolutely, Kaylee. I think there's a lot of people in the soft landing camp that are running victory laps at the moment, and I think that is premature. I do think that let's get inflation down to 2%. Let's get all the way down to the dual mandate of the Fed of having full employment and inflation at 2%. And then we can begin to come with an evaluation whether this exactly was a soft landing or not. So another way of saying this is that if now the Fed pivot and the easing in financial conditions, if it does create a boom in the economy, which is what you should expect, the boom in the labor market, boom in the housing market, boom in services, boom in goods, well, why wouldn't that then start to create some renewed upward pressure on inflation? So in that sense, so far so good. On the last trading day of 2023, it does look like, so far, it does look like a soft landing, but we're just not there yet. And I think that's exactly what Jay Powell and several FOMC members have tried to tell us in the last 2 weeks, namely that we're just not quite there yet. So it's just a little bit too early to take the champagne bottle out here, even getting to the last day of the year.
WIRP Go, WIRP, the World Interest Rate Probability Function on the Bloomberg Terminal, used by a lot of people, referenced by a lot of people. I don't know, I've kind of lost some confidence in this thing, but it's telling me, multiple rate cuts next year, maybe as many as 6. Torsten, what's the market seeing that maybe you're not seeing and maybe some other economists aren't seeing? Because, boy, the market feels pretty aggressive here, or pretty dovish.
That's right, Paul. And let's compare that to what the Fed is seeing. The Fed is saying we'll have 3 cuts. And the last few days, we have been going up and down between 6 and 7 cuts priced into the market. So Fed Fund futures or SOFR futures have clearly been pricing in that everything is fine. We have arrived and nothing to worry about anymore when it comes to inflation or the economy. But the key issue still here is, if all this easing in financial conditions, if this continues into next year, and there are all good reasons to expect that, then we should expect to have a reacceleration in economic growth. So therefore, the conclusion still is for macro investors that we should still continue to just hold off a little bit here before we start celebrating. It is still too early compared to some of the risks that come along with now financial conditions easing so much, because easing financial conditions means a booming housing market, a booming labor market, things that exactly are and at risk of creating more inflation.
Okay, so Torsten, we've talked with you a lot now about monetary policy, but I'm usually down in Washington where primarily my focus is on fiscal policy. What about that side of the equation? As we get into 2024, there's going to be a huge conversation being had about spending cuts. There potentially could be a government shutdown. How much does that really matter to the economy right now?
Oh, that does matter a lot. This was one very important reason why the economy did so well in 2023. And as you have talked a lot about, of course, is that we have 3 different proposals that are still tailwind to the economy. And these initiatives that have all now been in place for quite an extended period are, of course, the CHIPS Act, the Infrastructure Act, and the Inflation Reduction Act. Those are all longer-term policies, but they are very important tailwinds to the economic outlook, and they are very important reasons why the economy actually has done better in 2023 than what most people expected. So fiscal policy, in particular, those three initiatives that are working as we speak in providing a tailwind to economic growth, of course, in every area of course, energy transition, also the chips manufacturing, and of course also on the infrastructure area, we have seen a significant tailwind, and that tailwind is going to continue into 2024. So from that perspective, yes, it's true there's debate about whether we'll get some cuts or what might happen, and of course what might happen in November. But the reality is, as we speak, that the tailwind from fiscal policy in 2023 has been very strong.
All right, Torsten, thanks so much for joining us. As always, Torsten Slok, he's a chief economist at Apollo. So in the radio studio, folks, we have a wall of video monitors for all the various cable networks out there, so just to keep up on all the news. One of them, I just had a graphic on there that said 1 million people are going to come to Times Square on New Year's Eve. God. Have you ever done that for the dropping of the ball?
No, I have not, and I'm not sure I ever want to.
I did it very early in my tenure in New York, back in the late 80s. It was fun, but it was definitely bucket list checked.
Yeah.
Done. Do not have to do that.
What was the temperature outside?
It was very cold.
Yeah.
But what I do remember, it was pre-9/11, so there was like 3 cops there. There's no security. You could do anything you want, but it was tame, relatively. You know, the usual knuckleheads. But now it's so highly controlled by the NYPD for good reason.
You got to wait out there all day. Right?
Yeah, I mean, who does? You know, so we were just kind of at a party. We walked down. We got as far as we could. We got to like probably 46th Street, and we're like, okay, saw the ball dropped, and said, all right, we did that. Don't have to do that again. So, so anyway, 1 million people in Times Square for New Year's Eve. Good luck to all of you. S&P 500 off 0.3%. The NASDAQ off about 0.7%. We'll have more coming up. This is Bloomberg.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
This is Bloomberg Markets. I'm Kaylee Lines alongside Paul Sweeney today as we come to you simulcast on both Bloomberg Television and radio, live from Bloomberg's radio studio in New York City. We're closing out 2023 here, and a new year will bring many things, including a change at the top at Morgan Stanley. Early in 2024, James Gorman will be stepping down as CEO, being replaced by Ted Pick. And this is, of course, after a 14-year run as Gorman at the top of the bank. Bloomberg's Sonali Basak actually sat down with both him and Ted Pick earlier this fall and talked about what's next for Morgan Stanley. Take a listen.
organizations grow because you have change. I mean, you're not going to grow by doing the same thing again and again. And I feel like we set this up several years ago with the board. We've had a very, very intentional process, and we ended up with a phenomenal outcome, which is Ted. And we've got other unbelievably good executives who are taking leadership roles as co-presidents, Andy Saperstein and Dan Simkwitz. So it's sort of what you hope for. I mean, you try and drive strategy, you try and put together a team, you try and deal with the inevitable knocks that you get from the market and the disappointments that come in times in any complex business. But at the end of the day, you're also trying to hand it off for the next generation. So it feels great, and it feels right.
You've been rumored to be a CEO contender for oh so long, Ted. How does it finally feel to step into the role next year?
Sonali, Morgan Stanley was the first place that I worked out of college. And 33 years later, I'm sitting next to Mr. James Gorman. It's the thrill of a lifetime. I'm so excited.
Now, you've really inherited a gift here, a massive transformation over 14 years, one of the best valuations here in global banking. But there are investors who are worried this is as good as it gets. What do you tell them?
There's more to come. There's more to come. We look at the 5-year chart, the 10-year chart, the 15-year chart. The wealth and asset management businesses have these remarkable durable earnings. The Global Investment Bank has lots of miles to go, so we're thrilled about the business strategy we have in place, and it's going to continue to deliver long-term value for shareholders.
Now, for both of you, we've been in such a prolonged bull market that has hit such volatile times as of late. Do you expect the next couple of years for Morgan Stanley to be a little more choppy?
You know, I don't know. It's I thought this year would be tough, and it was. A lot of what's going in the market conspires against our particular business mix. Some of the more commercial retail banks, mortgage banks, very different business model. But our turn will come. I think, you know, I personally think the U.S. has dodged a recession. I think the Fed is very close to being final, within probably 25 basis points. We're starting to see activity. Look at the Chevron deal we just announced the other day. I mean, phenomenal. So we're seeing activity in different sectors. It's coming alive now. So no, I think the next couple of years will be great. But what I care about is over the really long run. When we set about on this journey, we weren't focused on a quarter. And if the stock takes a dip in a quarter, I say that's kind of good news because we're buying back stock. And every share you buy back, you're retiring a dividend. So shareholders who hang tough are getting a 4.5% yield, and we're buying back stock, and the stock's cheap. So it's kind of a good situation to be in. But medium term, no, I think the firm is going to do great.
Ted, what are the biggest challenges for you as you navigate this environment?
There's just so much opportunity. We're definitely in a new paradigm. Interest rates are going to be higher for longer, and the world's gotten smaller, which means the clients need advice. They need it in the wealth and asset management space. They need it in the institutional space, our corporate clients, and we're going to have lots of activity around those clients. So I just want to make sure that we are completely aligned in the business strategy we have in place. It's something that James has painstakingly put together for 14 years. The market knows what we want to do, so I'm incredibly optimistic over the next couple of years.
All right, that was Bloomberg's Sonali Basak sitting down with Morgan Stanley's outgoing CEO, James Gorman, and incoming CEO, Ted Pick. Sonali Basak joins us here in our Bloomberg radio studio. Sonali, excellent interview. It really feels to me that this is about as good as a succession plan can go. I mean, I was deeply involved with the Disney succession plan. Not good.
Yeah,
but
it's
very
been
good
messy.
Morgan Stanley.
It's been messy across corporate America, but for Morgan Stanley, this has been very, very orderly. And you have to think back in the last decade of all the succession races on Wall Street, even at Morgan Stanley. Remember, there were a lot of people John Mack, and even from John Mack to now, you've had a lot of talent at the top of Morgan Stanley. You think Paul Taubman, who went around and had instead created his own firm in PJT Partners. You have Greg Fleming, who had then left and created Rockefeller Capital Management. So there were a lot of people at the top of that firm in this succession race for years and years and years. But Ted Pick, you heard it yourself, he had worked there since college. He has long worked at the firm, a long-time deputy, not just to James Gorman, but importantly also to the previous president, Colin Keller. And so really deeply trained in some of the things that really make Morgan Stanley what it is. Particularly, he came out of the investment banking part of the world, a lot of capital markets activity. Morgan Stanley is one of the top in the capital markets world, as well as institutional securities. But really, as we know, Morgan Stanley more recently has gotten a lot of its gains from its wealth management unit. And the question of what that looks like in a higher interest rate environment, James Gorman had the benefit of very low interest rates for the last many years. Really? And so will this be the case that investors, wealthy clients of Morgan Stanley, will they be putting money to work depending on how high interest rates stay, moving that money out of cash into the markets, at what pace, and how does Morgan Stanley clip money from that business continuously?
Well, and Shonali, this gets us to the question of more widely the environment for these big banks going forward, knowing that they've been grappling with the rate environment this year, which looks like maybe it could change in the not so distant future. Also dealing with what has been, you were speaking of investment banking, a real kind of shortage of that activity, specifically in deals. So what's the picture looking like as we head into the new year?
The competition is extraordinarily stiff. So we're looking at the last working day of the year. So we look at those M&A league tables, and you have Goldman for the 7th year coming out on top, 7 years in a row. Wow. That means in 2016, you had Morgan Stanley on top. How big is that disparity? Just look at the third quarter alone, for example, Kaylee. Goldman's advisory fees came up above $800 million. Morgan Stanley's not only came in below $500 million, for the first time, I believe ever, you could check me on that, but they were they were surpassed by Evercore in the third quarter. Really? It is the first quarter that I've seen a boutique or independent investment bank pass one of the top 3 investment banks by revenue and advisory fees. So the competition is very stiff among the top 3 investment banks, Goldman, Morgan Stanley, JP Morgan, but now you have these incumbents, Centerview, Evercore, that are fighting really hard. Privately, what bankers tell me is, they're getting a lot of competition from these boutique banks that are able to pay these bankers a lot to come on board. Can that be sustainable into next year, where these independent firms are paying top dollar to steal bankers out of the likes of Goldman Sachs and Morgan Stanley?
One of the, I think, more amazing stories that came to light from your world, investment banking, Greater Wall Street, has been the continued growth, maybe the explosive growth in private credit. I mean, I always say, jokingly, if I were to come back again onto Wall Street as a young banker, I think I would look long and hard at private credit because so much capital is flowing there. And that's business that's being taken away from the bigger banks. So what do the Jamie Dimons, the Brian Moynihans of the world say about private credit?
Well, there are a few things. Publicly, they say that private credit is really a matter of higher regulation, tighter regulation on the banks, regulation, by the way, that we're going to see more of. Then you have this reaction function where JP Morgan and other banks are really looking at private credit partnerships. Goldman is boosting its own private credit division that has been in its asset manager. And so you see them warming up to the industry and the private credit industry turning around and saying, let us work with the banks. Privately, it looks a little messier. As deals start to come back, there's a big question on how these big banks that might be advising on these mergers and acquisitions, how they might react to the sources of financing that would come from the private credit universe. And interestingly enough, even though private credit has been a booming landscape, really, these mega deals, $5 billion or so, have only been seen for the first time this year. And you have warnings from rating agencies saying that deals that big could pose a much bigger risk to markets. So can they keep doing deals that big when the number of actual large-scale private credit players writing checks that large, Paul, can really be counted on less than 2 hands?
Yeah, that business has just been extraordinary, and the capital flowing there has just been amazing here. And we have a lot of these private credit folks come in, and they say, I mean, it's a booming business, very profitable, and it's. But they're taking business from the middle-sized banks in particular.
Absolutely.
So it's been great. Shonali Basak, thank you so much. We appreciate it. Shonali Basak, outstanding interview earlier this year with the senior management at Morgan Stanley. Management change taking a place at the highest level at the CEO as Mr. Gorman steps down after what I think most people would say it was a very, very good run at being the CEO of Morgan Stanley. We'll have more coming up. This is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7.
News Now, context changes everything.
All right, Bloomberg Markets back with you. Kaylee Lines, Paul Sweeney. We're simulcasting. That means we're broadcasting both on Bloomberg Radio and Bloomberg TV. We're in the Bloomberg Radio studio here. Cruising. I have never been on a cruise.
You're missing out.
But, Kaylee, you're an avid cruiser. Can I say you're an avid cruiser?
I am a multi-time cruiser.
Okay, multi-time.
I wouldn't say it's my number one method of vacationing, but yes, I've been on many cruises.
I've never been on a cruise, but I'm fascinated by the economics of the cruise industry. I followed the industry for a while, and it's just kind of what makes the revenue go, what's on the cost side, what makes a more or less profitable cruise. And boy, no industry was hit more immediately from the pandemic than the cruise industry. And what I remember vividly as these companies, literally in the earliest days, the first week, going to the bond market and raising cash.
Yes.
Because they knew their boats were not going to be sailing. They were going to be docked for who knows how long, and they didn't probably expect it would be that long, but they said we're going to need cash. So it's amazing. But the good news is the cruise industry is back, baby. We spoke just earlier with Carnival CEO Josh Weinstein, talking to us and giving us the update on Carnival and the cruise industry. Let's take a listen.
2023, we wrapped in November, on November 30th, and the one word that we like to use as a summary is record. We had record demand, record yields, record pricing, record bookings, forward bookings, record onboard spending level. So really across the board, our business has really thrived in 2023, and we expect much more in 2024.
It could continue, because you're such a great gauge of how customers are feeling. You just have a great read on it. Are they continuing to spend? Are they continuing to do advanced bookings? And then once they're on their ships, Josh, continuing to spend as well?
Yeah, that is exactly what we see. As a matter of fact, our Q4 was, from a pricing standpoint, the highest all year. So it's accelerating, it's not decelerating. And then when we look forward, we're actually 2/3 booked for all of 2024 already.
It's nice visibility.
It's not too bad. We're about 10 points higher than we were last year. And on top of the ticket bookings, we've actually started pulling forward onboard spend. So we have more or less about a third of our onboard spend being prepaid in advance. So we have a really good amount of visibility. And those booking trends, they just haven't slowed down. Every quarter this year, people expected it's gotta slow down. We're gonna see something. The consumer's gonna get impacted. And the fact is, with our business, we haven't seen it. It's record after record. As a matter of fact, we just ended the 2 weeks of Cyber Monday and Black Friday at more records. And it's not just coming from one brand. It's not coming from the United States. It's global. It's with our global portfolio of brands, which is really, really encouraging.
Do you think we're moving, good morning, good to meet you. Do you think we're moving from many CEOs similar to yourself that I've sat with that run global airlines and global businesses have said, we've lived through a period of revenge tourism. We were all locked up for a period of time. This is something, we had this parabolic reopening and you had a parabolic rebooking. Are we evolving into some kind of new cycle? You say there's no end in sight in this demand. So if we've ended revenge tourism, how do you describe the next evolution?
Yeah, that's a great question. So we don't think this is revenge anymore. This is not pent-up demand. It's 2 years on from when we really got back in full as a corporation. This is people who have decided what's meaningful for them. How do I want to spend my life? And experiences are what they're looking for. You know, unforgettable memories and creation with friends and family. And that's exactly what cruising has to offer.
And that's what I sat down with the Accor CEO and he said, look, I haven't got enough hotel rooms and I haven't got enough high-end staff to help me run this business, which then takes me to the cruise is the high-end hotel, but to what extent are those packages off ship and onshore, those additional spends, are they critically important to the expansion and the turnaround from the loss that you've had? Do they add incrementally or significantly?
So, I mean, when we think about our business, we're a little bit different from when you're looking at hotel companies. You know, I'm staying in a hotel in New York, and I won't tell you which one it is, but I'll tell you the service is not very good. And we've learned how to live with that as a society. It's almost a tacit acceptance. No, we should not. No. And the cruise industry, our brands did not deviate from service level. Our guests have high expectations, and we aim to exceed them. We do not close off floors. We do not shut areas down. We do not skimp on the services that we used to offer. It is full steam ahead, and that's what people expect, and that's what they're willing to pay for, and that's what we're seeing.
That was Josh Weinstein, the CEO of Carnival Cruise Lines, on Bloomberg Surveillance earlier today, talking about the real demand that is out there for cruises. It might not be coming from Paul Sweeney, but clearly a lot of people are out there taking advantage of, you know, the all-inclusive drink packages, and you wake up in a different place every day.
Charlie Pellet's a big cruiser.
I think more people should be big cruisers.
Yeah, I'm going to check that out. All right.
Although I will say I have not been on a cruise post-pandemic. All of my cruising was pre-COVID, and I haven't seized on that part of the revenge travel trend yet. So let's get more on what exactly travel trends are looking like. Joining us now is the points guy, Brian Kelly. Very nice to have him on the program. Brian, obviously we're coming out of the holiday travel season for 2023. We're just coming out of 2023 as a whole. And when you're looking ahead to 2024, how much is that travel demand going to be resilient? The CEO of Carnival there just suggested that this is no longer revenge travel that we're seeing. That's over, and demand is still sticking around. How do you see it?
Yeah, I see it the same. You know, revenge travel to me is sort of like people were paying ridiculous amounts to go to Miami. I remember when hotel rooms in Miami were like $2,000 a night, and I think now consumers are much more discriminating. They want better experiences. So we're seeing a big shift into adventure travel. On Hotels.com pulled a bunch of data recently. People are now looking to stay at really unique accommodations in ryokans and going to Morocco and staying at Riyadh. So I think consumers are spending. They just don't want to get stuck in that pandemic habit of overpaying for moderate hotels.
So, Brian, where are we? You know, we just heard the CEO, Josh Weinstein, the CEO of Carnival, talking about he's just mentioned he was in a New York hotel, and he's not having a great experience. Some of the services maybe have been cut back. You know, initially, when things were opening back up, hotels would say, we're not going to make your room every day. We'll make it once every 2 or 3 days. And, you know, we did see some service issues as that industry tried to get back on its feet, understandably. Where are we in terms of the hotel industry and staffing and service levels? Are we back to pre-pandemic levels?
We are not at pre-pandemic levels. And really in the mid-tier, they took the pandemic as an opportunity to roll back room service, cleaning. You kind of still have to argue at some of those mid-tier properties to get those same perks back. I think at the luxury side of things, the luxury hotels are now competing like never before. I think the service levels are back at the high end of the spectrum. But no, in general, a lot of hotel chains took this as an opportunity to cost cut in the name of safety and then never really take it back to where it was.
Well, Brian, you talk about the high end of the spectrum. What is the difference between kind of the luxury tourism and travel now and those seeking deals? Are there still good deals to be found, and where are they?
Yeah, there are actually really good deals, and airfare has come down quite a bit. Gas prices are down as well. So there is a positive outlook for travelers in 2024. The budget airlines are actually struggling because the consumers are spending on these bespoke experiences, and they're spending in first and business class. I don't know if any of you looked at flights to Europe this past summer, but I was absolutely shocked. $8,000 to go to Paris from the U.S. So the airlines are making a fortune. You know, United has a big bet on the Pacific. They just launched a new route to Christchurch, New Zealand. They're seeing strong bookings. Asia's now not quite back to where it was, but increasing dramatically. So the gains in travel, I think, are international and luxury. You know, the JetBlues and Spirits of the world, they have a much less rosy outlook. And I was just checking, and back to your question on where to find the deals. I love this tip, and no one knows about it, but Google Flights. So google.com/flights, that's where most people, travel experts, go to search airfare. They have a little feature called Explore. So it'll say flights, click the Explore map. You can actually type in New York to say Caribbean. Say you want to go for a week in March, you can basically reverse engineer. And this is what I'm telling people. There are deals out there. You just need to know where they are. So you can put New York to Caribbean and see where the cheap flights are. That's how you find cheap fares these days.
Always not me on Google Flights right now.
Yes,
Paul.
I know. I'll take over. So Brian, my personal flying policy these days is I only fly when I get paid to fly, with a couple of exceptions coming up. But where's the airline industry in terms of capacity today? Can they handle these record flights and record number of flyers we're seeing? And that includes the whole TSA folks. Where's our system these days?
You reminded me of Naomi Campbell. You only get out of bed for $10,000 or more. I like that. So capacity is an issue. You know, there still are strains on air traffic. The FAA actually just opened up new lanes along the East Coast to allow more planes to fly, but our airports are congested, especially in New York. And while there are some renovations going on at JFK and some of our nation's biggest airports, it's not really going to create the capacity we need. So there are issues there. Airlines can't just expand and add tons of new routes, especially to places like London. We've seen JetBlue try to expand to Amsterdam and London. They're getting the second-tier airports. So, you know, these airlines are struggling to grow and running into a lot of challenges. So they need to figure out how to maximize the revenue of what they have today. And that's why we've seen airlines really charge a premium. And customers are paying for first class. You know, 10 years ago, 80% of first class seats on Delta were given to elite members for free. Now it's flipped. 80% of people are buying first class and 20% are going to elite travelers. So the airlines are doing whatever they can to maximize everything on board that they have today.
Yeah, I just recently went to Europe, and to your point, Brian, the actual business class tickets where you get the lie flat seats and everything were wildly expensive. So I did premium economy for the first time.
Yeah, how was that?
It's pretty nice.
All right.
You know, it definitely made a difference.
Of course,
also,
I couldn't do that.
Yeah.
Please.
Okay, not for everybody. And Brian, you've got me on Google Flights now.
Yeah.
Just so you're aware, $67 round trip, New York to Miami,
Wow.
January 21st to 27th on Frontier.
On Frontier,
so something tells
okay.
me maybe Paul wouldn't be flying Frontier. Brian, you were talking about how airlines are able to maximize all this stuff. They're getting people to pay for first class. And that brings me to lounges. When we think about points and rewards, it feels like everybody gets to get in the lounge now, and the lounges are too crowded, and they're starting to pull everything back. How much more kind of restriction in that are we going to see?
Well, so back to the point, the airlines need to make more money out of what they have today. Adding tons of new planes and routes, they can't even buy new planes. You know, there's backlog. So what they're doing is turning to loyalty. All of the credit card, you know, all the major airlines, Delta, United, American, they're making billions from their credit card partnerships, and they're doubling down. So what we're seeing now in terms of lounge access, you know, Delta really is pulling back next year, and especially in 2025. American Express Platinum, you used to be able to use that to get into Delta lounges and even bring guests into their own Centurion lounges. Now they're making you spend at least $75,000 on the card to get a perk that used to be for free. So, and it's brilliant business when you think about it, because every time you use a credit card or an airline co-branded card, that airline's making money. So they need to figure out how to take their customers that fly a couple times a year and get a piece of their spend every single day. So that's the trend. These frequent flyer programs are now frequent buyer programs.
Real quickly, Brian, 30 seconds. What's a wellness resort? It doesn't sound like something that's down my alley.
Yeah, yoga and, you know, no alcohol. Actually, some of them have alcohol. I have Miraval, and Miraval's a Hyatt property. You can use your Hyatt points at Miraval properties. But, you know, that definitely is a trend, people wanting to escape and focus on wellness. But
All right. I like the escape part. I'm just not sure about the wellness. Brian Kelly.
Meditation.
Yeah, thank you very much. Brian Kelly, he's the points guy. We always learn something today. Every time we speak to Brian, he's the founder and CEO of the Points Guy. And if you're good at it, and my daughter, who's very good about maximizing value on points and getting deals and jetting all over the place. And why is Barcelona the place where the kids go?
Got the clubs.
What is it?
Clubs.
Clubs?
Yeah.
Don't we have clubs
Spanish,
in New York?
like tapas and good food.
All right. I mean, every mid to late 20s person I talked to that went to Europe this summer, Barcelona.
Yeah.
I'm like,
it's the hot. It's
right.
the hot place.
It feels like it's the Paris of maybe my generation. I don't know, because Paris was kind of the exotic European place to go. Maybe now it's Barcelona. So anyway, the Points Guy gives us lots of good things.
You can take a cruise to Barcelona.
I can take a cruise to Barcelona and knock off 2 bucket list things. All right, S&P 500. We're trading off here today. We were kind of mixed right at the opening, but the S&P is off about 0.5%. The Nasdaq off almost 0.9%, and the Russell, which had been outperforming over the last 2 to 3 months, it's off 1.3%. We'll have more coming up. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Where do you think the future of technology is going in Silicon Valley and elsewhere over the next 5 or 10 years?
Technology is an underpinning. It's not its own industry. It is a part of every industry, and it's actually going to increase productivity and actually make our lives better.
DOJ or other authorities
could face bigger challenges next.
That was going to keep Great World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Welcome back to Bloomberg Markets. I'm Kaylee Lines alongside Paul Sweeney, simulcasting on Bloomberg Television and Radio today as we round out the year 2023. It is indeed the last trading day of the year. And of course, 2024 is going to be a doozy for many reasons. Obviously, there's a lot of questions for financial markets as we head into the new year, but a big one actually surrounds political risk, as 2024 is an election year. And there's been some developments that pertain to the election cycle. Maine overnight, the Secretary of State there ruling that Donald Trump should not be on the primary Republican ballot in that state on the grounds of the 14th Amendment, very similar to what the decision came out of the Colorado State Supreme Court that also ruled against Trump in that area. It all comes down to his actions on January 6th and that idea that he engaged in an insurrection. But the legality around all of this is quite murky. So luckily for us, we have Bloomberg's resident legal expert, David Weston, with us here in our radio studio. So, David, I know that you've looked at this case, the question surrounding the 14th Amendment. I've spoken with people who've said if you read the text, all it says is engaged in insurrection or rebellion. You don't have to actually be charged with it, even found guilty for this to be used against you, essentially. What's your read on this?
Well, as you know, Kaylee, in law, it's not just what the language says, but who gets to decide. And the question is, okay, you can say you believe that happened, happened, who determines that? This is a fairly important question, right? Who gets to run for president of the United States, and ultimately who may be the president of the United States? And sure, the language is clear to some people. Clearly, what Donald Trump did engage in the conduct that's prohibited, but other people have a very different point of view. So are we going to leave it up to a Democrat who's a Secretary of State of Maine to decide that question? I think that's the big issue. Who gets to decide?
All right, so it feels, David, like the Supreme Court is going to have to decide. Is there a sense of, A, is that true? This is something that the Supreme Court will have to deal with, and if so, when?
Well, first of all, the Supreme Court doesn't have to do with anything. Okay. The way it's set up, they have discretion, so they can decide. Okay, I'd be surprised if they punted on this one. It's just too important. And we have the Colorado decision of the Colorado Supreme Court that keeps actually Donald Trump off of the ballot. So I would be surprised to see the Supreme Court decide they're not going to take the case up. There's also a conflict in the lower courts, which usually triggers Supreme Court review. So I think, in all likelihood, we will hear from the Supreme Court on this subject.
Okay, well, and David, of course, you have firsthand experience with the Supreme Court. You clerked in the Supreme Court earlier on in your career. How much awareness is there inside that institution of the political implications of the rulings they are making, knowing that, yes, there is a way to read legal text, and in theory, this is all supposed to be done in a vacuum, but these are real people. They don't live in a vacuum. So can you just bring us inside on consequential decisions like this?
On the one hand, Kaylee, they are appointed for life, which gives them some immunity, and they don't have to worry about elections. And it is a fairly insular place up there. It's a fairly small institution inside those marble halls. I mean, they're really just the clerks and the messengers and some support staff and the justices themselves. On the other hand, they do read the newspapers. They do watch the news. They know what's going on. And they certainly are very aware of the political consequences. The question is, being aware of it, what do they do with that? And at least when I was there, which is a long time ago now, when I was there, they took a great deal of pride in saying, we are the court, we are not influenced by politics. You can't ignore it, you can't be oblivious to it. And then let's be honest, the Supreme Court has dealt with very highly politically charged issues before, including involving the president, back to Richard Nixon and the Nixon tapes. They took up that case. And also, we had it more recently in Bush versus Gore when they were deciding who won that election in 2000.
All right. So going back to just real quick, the timing, is it their decision, the timing? And if so, because it feels like some experts are telling me this needs to happen in the very early part of January.
Well,
ideally.
First of all, they're not going to get rushed, but in all likelihood, people will ask for expedited review. And I mean, again, go back to U.S. versus Nixon. That was actually happened over a summer, and they decided in late July in that case. Okay. And Bush versus Gore, it was, I mean, by Supreme Court standards, it was very fast. I mean, it was a matter of a month. Now, we might think that's not that fast, but they'll take it up fast enough. And believe me, the parties will make it clear to the court what the timing is and why it's important for them to decide something fairly quickly.
Okay, so obviously there is a lot to come in 2024 in the political universe, but there's also more that is expected in the financial universe, David. Obviously, this is now a market that is betting the Fed is going to be aggressively cutting interest rates in 2024. That surely is going to factor into the election, as so much is about the economy in some form. And I know this is a conversation you were having with Larry Summers, the former Treasury Secretary, earlier today, the idea of what exactly the Fed is likely to do, maybe the market mispricing that. Let's just take a listen to what Mr. Summers had to say.
We basically got an outcome that was closer to Team Transitory's prediction. Inflation came down with policy that is what their opponents were insisting on. Interest rates far beyond what they were recommending, far beyond what the Fed was predicting as of almost any date in the recent past. So the record's a bit ambiguous. I'm not sure we're really a 2% target inflation country in any durable sense.
Okay, so he thinks the market, David, is underestimating the inflation risk that is still out there. What about the growth risks that are out there? Knowing 2023 was a year when many said, oh, watch out, the recession's coming, softening is going to come, and yet we haven't actually seen that materialize.
Yeah, I think, Kaylee, one of the starting points is how humble we should be, how modest we should be about our ability to predict anything. I mean, the Fed didn't predict they'd end up here. The markets didn't predict they'd end up here. 2023 was full of surprises for analysts, for the Fed, for economists, including for Larry Summers. Summers, and he admits that Team Transitory, as he calls it, their predictions were closer to right than he would have expected, although he says it's because, in fact, what the Fed did was more aggressive, which is something he wanted to have happen. So we have to be modest about what you expect. He still sees there's a fairly balanced risk, and this may be a little surprising, between recession and inflation getting out of control. I think most people, led by Paul Krugman, who's really criticized Larry quite publicly on this, Paul Krugman says, no, our biggest risk here is recession, not inflation. Larry thinks there's still a significant risk, not least because of the anticipation of the Fed cutting and what that's done to the stock market and the extent to which financial conditions have loosened. He said that really brings inflation possibility back into play.
David, does Larry Summers think that the recession is still on the table, and if so, kind of front burner, back burner type of thing?
He says it's too soon to tell, basically. He says it's too soon to tell. He doesn't see us on a trajectory to 2% inflation right now, which raises questions for the Federal Reserve. He's not predicting a recession. He's just saying it's a more symmetrical risk between inflation and recession than we had before, because, in fact, he does not think we have conquered inflation quite yet.
Well, I'm sure we'll hear more of this conversation with Larry Summers tonight on Wall Street Week, which, of course, airs at 6 p.m. Wall Street time. It's going to be your last episode for 2023. So how else are you looking ahead to 2024? Who you got on the program?
Well, we have to talk about China, right? Given what happened in 2023 and what we anticipate in 2024, we have Mary Lovely from Peterson, who really knows this backwards and forwards. Just recently was in China talking with economic officials there, talking about the fact that China has rebounded some, but there is what she calls a malaise that's set in, particularly in investment there and consumers and goodness knows in foreign direct investment, what's happened. And one of the things, of course, that happened in 2023 was that attack by Hamas on Israel and the war that ensued. That has really exploded in a lot of places around the world, including on college campuses. So we have on Scott Bach of Greenhill, who until recently was the president of the trustees at University of Pennsylvania. You recall that Mark Rowan of Apollo demanded that he resign along with the president. He did end up resigning. So we have him on to explain what, from his point of view, went on inside Penn, and indeed, why did he step down ultimately? Did Mark Rowan have a point?
And there's still pressure on the president of Harvard at the moment. We haven't seen any change there, but it's amazing, David. That story kind of reminds me a little bit of the late 60s and the unrest on college campuses and, you know, administrations and leadership under pressure from lots of different parties. Then it was the students. Now it seems like it's more some of the alumni.
It's interesting you say that, Paul, because that's exactly one of the analogies or contrasts that Scott Bach draws. He said, look, this is not nearly as bad as it was actually in the 60s. By the way, I went to college starting in 1970s, so that's sort of my time period. I remember this. But one of the points he made is it was, and this is true, it was really widespread on college campuses like University of Michigan, where I was. He said this is a relatively few number of students and faculty members who were involved. And he said the main thing is we've had it so quiet for so long, we're overreacting now. I mean, this blew up. Let's not overreact because it's a relatively few people and we just don't know where this is going to end up. But he says it's not like the 60s and the 70s, in his view at least.
Interesting. Wall Street Week, absolutely one of the most iconic brands in financial broadcast journalism. Remember well for many years. It was the go-to place, and now David's reviving it and has some great guests, so check that out. David Weston, thanks so much for joining us here in our Bloomberg Radio studio. This is where it all happens, of course. S&P 500 off 0.5%, NASDAQ a little bit more off, about 0.75%. Yields coming in just a little bit. We've got the 10-year Treasury yielding 3.85%. WTI crude oil pretty steady here, $71.65 a barrel. We're going to have more coming up. This is Bloomberg.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. You know, we don't have the luxury of saying we can temporarily stock out on our product because these products, these medicines keep people alive.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
All right, welcome back to Bloomberg Markets. Kaylee Lines, she has ran down the hallway. That's okay. Caroline Hyde is here. We've got Caroline for the next
Places to go,
2
to
hours.
see, Paul.
Exactly. She's ready to start her new year. Looking, at these markets, Caroline, it's interesting. It's kind of a little bit of a sell-off today. You know, it's obviously a Friday, the last day of the year, and so on. But a little bit of a sell-off here. I thought we were going to have a nice little quiet day. A little bit of a sell-off here. But boy, what a year it's been. What a 2.5, 3 months it's been to finish out this year.
Yeah, record couple of months for the global bond market. Stocks were at a record high. If you're looking at the NASDAQ 100, this is the first time in a couple of days that we say it's not. It's actually going to see the NASDAQ down on the week, and we're currently off just by about 0.5 percentage point on the S&P 500 as well. It's still clinging to gains for the week, and that would be 9 straight weeks of gains, but not so much for the tech stocks. We're going to dig into that with Abigail Doolittle in a moment. 10-year yield flat, as we'll see, 3.85. This is fantastic. There's a note from Bloomberg just showing how basically it's a complete round trip for the year.
For the year. It's like, why did we even do this?
Exactly. Why did we sink to 3.5? Why did we rise past 5% if we're just going to close up at 3.85? There was lots of money to be made and lost within that year, of course. Bitcoin off by more than a percentage point, so we'll dig into crypto in a little bit. But I think we can take it on to Abigail Doolittle just to sort of tie up this year in a bow. And with the stocks that have just been on such a tear for this year that have driven us higher in the tech space, bit of a damp squib for the final Friday of close.
It's not entirely surprising, mainly because of that big year you were just talking about. I mean, NVIDIA up more than 240% on the year, Meta up nearly 200%, Tesla a double-digit gains for a lot of these big tech. So here we have the final Friday, anemic volume, and you have the bears taking it. Now, technically, there is a little pattern, a bearish pattern that started to form mid last week. It's called the diamond top. It's actually morphed into a different type of pattern, and we don't know that it's necessarily going to confirm, but I'm not surprised by today's selling. I'd actually, talking to somebody last week saying that if that pattern is to work, it means that we're actually going to have some selling action next Thursday or Friday, which seems very unlikely. So here we have it, and it is in these big tech names: Apple, Amazon, Meta, Tesla, Nvidia, Microsoft, Google. Those are the top 8 big laggards for the S&P 500, all down 0.5% or more. Actually, Microsoft is not. It's down about 0.2%. So just some chips off the table. You know what's interesting, really, really interesting to me? At this time last year, everything was in the doldrums, the sky was falling, but we did have a little bit of a Santa Claus rally, and the Santa Claus rally is very predictive that if the last 5 trading days and the first 2 of the new year are up, and then there's a January calculation, a February calculation, you're gonna have a big rally. Lo and behold, that was true this year, and last year when I was talking about it, because the mood was so sour, people really didn't make much of it. Now, what I will say right now is there is a Santa Claus rally, but because of today's bit of selling action, we're up 0.3% over the last 5 days. So it's going to be really interesting to see how the first 2 days, trading days of January open, because you could actually not have a Santa Claus rally, even though everybody's been talking about this massive rally, and rightfully so. I mean, it's been parabolic since late October.
And one of the aspects of this rally over this late October rally has been the breadth has improved. And I know that's something that you've called out. Others have reported that, you know, the first 9 months of the year, there was very poor breadth in this market. It really was the Magnificent Seven, but we have seen that broaden out a little bit.
We have, especially to the small caps. At one point this year, the small caps were actually down on the year. I believe Abercrombie and Fitch, there's a nice article in the Bloomberg Terminal talking about how it is risen this year even more than Nvidia, up 300% on the year, which is just incredible when you think about that for a retailer, especially given the expectations coming into this year. But small caps right now about up 17%. From a sector standpoint on the year, utilities, this is interesting. Utilities down about 11%, energy down 5%, and I'm rounding these out, and consumer staples down 2.4%. So we have 2 of the defensive sectors down. In some ways, that's risk on. And then you do have healthcare up slightly, real estate, financials, materials, and then those mega cap tech sectors all up 41% or more, which just seems absolutely ridiculous to me in some ways. But to your point, yes, more sectors are higher, because if you had looked at the sector function 6 months ago, it really would have only been those 3 sectors that were up.
Abigail, always taking us through the movers and the shakers within the equity market. We thank her for it. And, well, let's keep the conversation going as to whether we will see an extension of a Santa Claus rally into the moon music for January and February. We've got Christina Hooper joining us now, Chief Global Market Strategist over at Invesco. Christina, always great to have your voice across our programming. And you seem to be liking equities at this particular moment in terms of risk sentiment.
Oh, absolutely, Caroline. What I would anticipate is that as we head into 2024, we're likely to see markets discount an economic reacceleration in the back half of 24. And that should benefit small caps and cyclicals the most. In fact, I think we've already seen a preview of that late in 23. I think that continues. Now, in the back half of the year, we could see some give back just because markets will then start to discount 2025. But I do believe the early part of 24 is likely to be very positive, although there could be some volatility because there still is some confusion around Fed policy, given that the Fed doc protests too much.
Okay, so talk to us a little. We're going to dig into perhaps where the Fed is going to go throughout the show. What do you make of central bank policy? Do you think that they will be cutting as much as the market seems to think they will be?
I think they ultimately will. I think they have another goal right now, though, which is to tamp down an easing of financial conditions. And so that's why we're seeing predictions, their own dot plot saying only 75 basis points in cuts this year. And of course, some of the hawkish language we've heard recently. I think that ultimately will be a non-event, that we will see probably between 100 and 150 basis points in cuts, not because the economy deteriorates a lot. I don't think that's going to happen. I think it's because where monetary policy is quite restrictive, especially if disinflation continues.
Christina, reading through your notes, I found a juicy nugget here in your equities outlook. We see the greatest potential in emerging markets. Talk to us about that.
Sure. Well, emerging markets are likely to perform well. Historically, they have when the dollar has weakened, and I think we're certainly seeing that trend start, and I think it will continue in 24. Emerging markets are well positioned. We saw some emerging market central banks act more quickly in the face of inflation. So they're in a better place in terms of normalizing monetary policy. And I think we're likely to see, especially Asia EM, perform quite well this year. I think that is going to be one of the key stories of 24.
That's a good one. I like that. We're going to circle back on that throughout the year. I look at my Bloomberg Index browser, Christina, which allows me to see total returns in the fixed income space. And the good news is for bond investors, they have positive returns in 2023 versus some brutally negative returns in 2022. What's your fixed income outlook here, after a decent 23?
Well, investors certainly went through a lot of pain in 22 and certainly saw a better environment in 23. I think that fixed income is well positioned in 24. Yields are certainly higher. My expectation is that investment grade bonds are going to be an area of particular opportunity. I don't anticipate a soft landing so much as more of a bumpy landing in the first half of the year. And I think that the sweet spot for the economy will be investment grade corporates. Also, I'm excited about emerging market debt. I think this is a time where we want to be, we want to have a more weighting to both emerging markets equities and emerging markets debt. In terms of duration, longer duration, and we've been talking about that for months now. We think that going long is important. And I think ultimately, when we've looked at past cycles, it has been a good time to go long duration.
One interesting point from your notes as well was alternative assets. And within there, commercial real estate. You like it. You favor it. Why and what part?
Well, first, I have to say, commercial real estate covers a large swath of territory. Office space is only a relatively small portion of the commercial real estate picture. But even within office space, I think we've seen the worst in terms of occupancies. We're in recovery mode. It could take some time. But the key is that rates are coming down, and that has played such an outsized role in pricing for real estate. So I think that 2024 represents opportunity for commercial real estate if, as we anticipate, rates come down, mortgage rates come down. This could be quite an attractive environment.
Christina, mentioning and discussing emerging markets, it makes me think about China because it's such a big part of the MSCI. China was a disappointing story for most investors in 2023. The economy did not rebound as much as people thought on the great reopening, if you will. How do you view China in 2024?
So China is an interesting investment landscape because you're absolutely right. There was some level of disappointment in 2023. The economy had a nice reopening, but it wasn't as strong as many anticipated. If we were to sort of dive down, services did a lot better than manufacturing. And I would argue that manufacturing disappointment was largely about a decreased global demand that impacted many economies. Now, there, of course, were issues, and I think they were largely around consumer sentiment in China and a view that there was a need for more stimulus. So we have seen in the back half of 23 more of a rollout of policy that has been quite targeted. And I think if we see a continuation of targeted stimulative policies coming from China, it could be quite a good year for consumer spending.
Christina, if we think about this time last year, we thought China was going to do well. We thought the US was going to dip into recession. We got a lot of calls wrong, and we're going to be dipping into that entire discussion a little bit later. But what out of all of this viewpoint that you have in terms of potentially a little bit of refirming in China, the fact that US equities could be good, what are the risks to that from your perspective?
Well, I think the greatest risk facing investors right now is that we do see a hard landing for the economy. I would assign that a very low probability, but I do believe that when you have incredibly aggressive monetary policy, and it's quite synchronized across a number of different major economies, that is the single biggest risk. And of course, that could take down a stock market that has a very different expectation for the economy. But again, I would say that is a very low risk. Now, in terms of which markets are going to perform better than others, I think because we're going to see that weakening in the U.S. dollar, and I think that's I have a lot of conviction in that call, that should bode well for economies outside the U.S. And I think there are, of course, other factors at play as well. But at the end of the day, we can be wrong, especially when it comes to tactical allocations. Everyone can be. And that's the importance of being well diversified.
Christina, thank you so much for joining us. As always, we're a little bit smarter after spending some time with you. Christina Hooper, Chief Global Market Strategist at a little firm called Invesco. Boy, Christina's one of the best.
Yeah.
I mean, covers everything. Has got a nice, clear opinion on so many different asset classes and geographies, and kind of ties it all together. So, again, I always feel a little bit smarter after chatting with Christina.
Yeah, we love her being a regular. I'm also glad she got my hair memo.
Yes,
those
exactly.
Radio audiences who couldn't see, like, we are of one today.
We are, exactly. I mean, when that double shot came up on the screen, I was like, whoa. That caught me by surprise. Yeah, exactly. Oh, it is? Okay, very, very good. All right, looking at these markets here, last trading day of the year, it doesn't look like we're going to hit that all-time high here today. Yeah, exactly. S&P 500 off about 0.5%. NASDAQ off about 0.8%. And the Russell 2000 off 1.3%. But that has been a real positive story. The Russell 2000 over the last several months outperforming the S&P, which a lot of market watchers and technicians will tell you that's a good sign as to the health of the underlying market, to see greater participation, particularly of the small cap stocks. We'll have more coming up. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Markets. Caroline Hyde, Paul Sweeney. We're broadcasting live. We're simulcasting live from the Bloomberg radio studio in our HQ in New York City. Looking back on 2023, boy, geopolitics was front and center, probably a lot more than people would like for a lot of reasons. First, you had Ukraine, and now the Middle East flaring up yet again. And you have to factor that into your investment outlook. That's certainly been the case throughout this year. That's why we're happy to speak with Wendy Schiller, professor at Brown University. Professor, thanks so much for joining us. I want to start just on the domestic political front here. There are a lot of states that are questioning whether former President Biden can even be on the ballot.
President Trump.
Former President Trump, thank you very much,
yeah.
can ever even be on the ballot this year. How do you make, what do you make of what's happening here on some of these states?
Well, I mean, we've had Colorado and the state Supreme Court ruled there, and then Maine, it was a decision by the Secretary of State of Maine. And the issue is, did Donald Trump commit insurrection in allegedly inciting the January 6th riots, but also, trying to sort of undermine or change the electoral results of 2020, fake elector schemes, all of his claims were thrown out, 60 different court cases. But he was not ever convicted of insurrection, which is really important part for the 14th Amendment. If you commit insurrection, if you were a Confederate soldier and you took up arms against the United States, the Union, you were considered an insurrectionist. But even Jack Smith is not charging former President Trump with insurrection. So in this case, it's a pretty wide application of the 14th Amendment for somebody who has not been convicted in a court of law of insurrection.
Nevertheless, does it set the stage for some sort of constitutional showdown, as some experts think? Is this going to the Supreme Court?
Well, the Supreme Court has to decide. Certainly the decision in the Colorado State Supreme Court, that's a natural path to go from a state Supreme Court to the federal courts. And of course, this is a state question. Who gets on the ballot is time, manner, and place. In other words, that clause of the Constitution, that's controlled by states, not the federal government, unless it's overridden by a federal law. We don't have actual massive federal law on ballot access. We leave that to the states. So the Supreme Court has to decide, are they going to punt it and just say this is a state matter altogether? They've been devolving a lot of things to the state in their term. Or will they say this is a misapplication of the provision of the 14th Amendment and get involved? And I think people don't know yet. But now that there's a second state involved, I do think it's going to be more pressure will build on them to at least hear the Colorado case.
Meanwhile, of course, many anticipate he is indeed the front runner as it stands for the Republican nomination. We also know he'll be up against one current President Biden. President Biden being busy at the moment, he's taken to the airwaves talking about an overnight Russia attack, launched large aerial assault on Ukraine. The latest attack shows Putin's objective remains unchanged. All of this while really President Biden tries to garner some sort of support for further aid to Ukraine and indeed to Israel at that. How much is that likely to be passed? How much is that going to be taking up the headspace of, well, the administration at the moment?
Well, the issue is that there's a very short window until the first deadline for refunding the government for fiscal year 2024 comes, which is January 19th. And then the bigger blow-up date is February 2nd. And so the House of Representatives is the place to watch. Certainly Livingston, the leader from Louisiana, and thinking about the speaker, thinking about whether that caucus can hold together. There's a very strong opposition to sending more money on behalf of Ukraine. Certainly the amount that the Biden administration is asking for, which is 50 or 60 billion. There's only 14 billion or so for Israel. Point is, there's enough people in that Republican caucus to kill any aid bill. So Democrats will have to come to the rescue. And Israel-Gaza is very controversial in the Democratic Party. So the appetite for sending more money to overseas countries while you're fighting about cutting the U.S. budget, which is the fight the Democrats and Republicans are going to have, that is an incredibly difficult path to walk for the current speaker in a divided Republican caucus.
And Wendy, it appears that one of the strategies from the Republican Party is to tie any aid to Ukraine and Israel to border security and maybe border policy. What's the status of that?
Well, that's actually a win for the Biden administration. If the Biden administration is forced, quote unquote, to accept more aid to reinforce the border, that means that they'll probably reinforce the border and diminish some of the migration that's happening, which is a soft spot for Biden going into 24. So if he has to, quote unquote, compromise, it's actually something that is in his favor because it better insulates him against charges on the border. We saw the Secretary of State actually go to Mexico to talk about how we can get Mexico to help with the border. So I think the Biden administration realizes this is a very important factor going into the election. Even people very far away from the border seem to be very concerned about it. And there's a big balance between worrying about Ukraine and Israel and our southern border. But that's a gift to Biden. Even though Republicans won it and they'll claim credit for it, it's also a gift to Biden that I think he'll happily accept.
Hey, Wendy, when our good friends in Washington do come back to work in the new year, they've got a big to-do list. I wonder I would guess at the top of that to-do list is it's keeping this government open and funded. How is that going to proceed, do you think? Or are we just going to kick the can down the road the entire year?
Well, I mean, because of the debt ceiling negotiations, it's very difficult to kick the can down the road. If they don't do certain things, bigger cuts will happen in the summer, which is closer to the November elections. So very few people want that. The problem for the Republicans is Donald Trump may very well win the Iowa caucuses on, I think, January 15th. The deadline is the 19th, and then he's propelled into the 23rd, which is New Hampshire primary. He is going to be the spokesperson for the Republican Party. And for some people, that's fantastic news. For other people, that's chaos. So if the Republicans in the House do not manage to keep the government open, that's further chaos. So it sets the stage for the Republicans bearing the label of chaotic and unable to govern. And I think that's what the Democrats are counting on to push Republicans to prevent any long-term shutdown.
This kind of takes us nicely full circle back to the discussion of an election in 2024 and who will be the front runner for the Republicans. I mean, just of late, we've seen Nikki Haley, who is gaining some momentum, sort of do a unforced error, once again, sort of being brought into a racially charged controversy that seems to be coming time and time again in the 2024 fight. Is she just unlikely to manage to win out, and indeed DeSantis at that point?
Well, we have to look at Iowa. You know, Trump has such a big lead in Iowa. Does that translate into a really big win in the caucuses, or does it really tighten up when they go in to vote? And if there's actually momentum, if either DeSantis or Nikki Haley gets something like 30% of the caucus vote rather than where they are on the polls now, or 35%, that shows some vulnerability for Trump. Going to New Hampshire, if Nikki Haley doesn't win but comes in really close second, for example, again, more momentum for the challengers to Trump. Then I think it's a little bit less certain that the party goes with Trump. So I think that's the big thing to watch in the next couple of weeks. Nikki Haley's remarks really reflect the divide in the Republican Party. DeSantis has already gone this way in Florida on the issue of revisiting slavery, discrimination, the legacy of the country. You know, there's a real appetite to move on from that in the Republican Party, but the independent voters and suburban voters that might be Nikki Haley's big base that can cross over and vote in Republican primaries, for example, they're uncomfortable with abandoning that, and they don't like that side of the Republican Party. So she's really caught strategically in a really difficult place, and who she appeals to in the next month.
Wendy Schiller, there's a lot of topics, and I think we're going to be talking to you often in the new year as we think about domestic politics, geopolitics in an election year. Wendy Schiller, she is professor at Brown University, and there's a lot of ground to cover in that type of discussion.
Yeah, we'll keep an eye on ultimately what all of this means to the markets, because we've been talking time and time again when it comes to M&A, when it comes to IPO windows. All of these are at the behest of ultimately the election. Before that, we will see potentially windows open. Mid the election, they will probably slam shut. So
that's exactly right.
It does build in a lot to the economic and market viewpoint here.
It puts pressure, arguably on companies and banks and markets to get a lot done kind of in the first half of the year. We've heard about a lot of IPO backlog on the street. There's a lot of M&A, presumably some backlog because there wasn't a lot of activity in 23. So there's an expectation on the part of some players that 24 can be better in terms of just market activity, in terms of capital raising, M&A, that type of thing. But again, perhaps not in the context of a general election in the back half of the year. So again, pressure on the front half.
And I mean, it does weigh perhaps in an individual retail investor's minds. Of course, all eyes on November the 5th, that is election day. It's going to influence personal finances with student loan crisis, with social security system, with the makeup of the Federal Reserve. We're going to dig into our personal finances coming up next, Paul.
Very good.
the reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Markets. Caroline Hyde, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We are streaming, simulcasting. We're doing all that kind of stuff. We're out there everywhere where you can find us here. Looking at these markets, a little bit of a sell-off today. Not much volume, of course, on a Friday before the holiday. S&P 500 off 0.6%. NASDAQ off 0.9%. And the Russell, which we've been following pretty closely over the past few months because it has been outperforming, it's off 1.3% here today. The VIX, I'm calling out for Tom Keene, right at 13. Yields a little bit higher on the 10-year, 1 basis point, 3.85%. Gold, it is a little bit higher, $2,066 an ounce. And WTI crude oil, now a little bit higher, $72.14. So a little bit of a sell-off in the equity markets today, Caroline.
Sort of mirrored in the crypto market as well. We're off by about 1.5% on Bitcoin, bit of profit taking after perhaps some of the rally that we've seen. A lot of that rally sparked by optimism around a spot Bitcoin ETF being signed off in early January. That is just one of the key dates that has been outlined in a great piece that we want to dig into now. The key 2024 dates to get your personal finances in order. Let's dwell on our own money management right now with Claire Valentine. We're pleased to welcome to the studio. And Claire, it's a great piece. Let's start on what comes thick and fast. I mean, of course, December the 31st is when you need to get your tax loss harvesting done. But January 8th, 10th, that's when you think an ETF could be signed off. Why is that important to a retail investor?
So this is a big moment for the Bitcoin industry and for markets in general. A Bitcoin ETF has been in the works for a long time. Bloomberg intelligence analysts think it's finally going to come around January 8th to January 10th, based on when the SEC delivers its ruling. That's big for retail and everyday people because that makes it easier to invest in Bitcoin. So maybe if you have thought about investing, but it seems hard to set up a wallet or use one of those crypto platforms, this could make it easier.
I see. So Jan 8th, 10th, one to keep an eye on. Meanwhile, we've got a little bit of focus on taxation, shall we say. January 16th is the tax deadline for the self-employed, but also take us forward to this imminent date, which is Sunday, by which you have to get your own tax loss harvesting in order. What could we be doing in the next couple of days, do you think?
Yeah, so this is for people who are taking an active role in their brokerage account. You can do tax loss harvesting. That involves selling a security that has taken a loss this year, and then you can replace it with a similar one if you want to maintain similar exposure. Basically, harvesting that loss or booking that loss when you sell between now and December 31st can potentially help lower your total taxable income.
Yeah, I got that phone call last year, last tax year, first time in my life from my financial advisor. We need to get some tax losses here. I was like, oh, that's not good. But I had some gains, but this year did not get the phone call. So far, so good. Fed meetings, they come. This year is going to be presumably Fed watching for rate cuts. How do you think about that?
Yeah, so these are big dates to put on your calendar. First one comes January 30th to the 31st. And then after that, there's one mid-March and at the end of April. Those are really critical to watch just to see what the Fed does. Hopefully rate cuts. The market's hoping for that. But those are going to be big dates for the financial industry as a whole.
And I'm looking at, you know, IRA. I've been a big proponent of contributing, maxing out your IRA. My kids that are in the workforce, they all max out. And that was, if I've done one thing right for my children, it's to get that into their head. Now, I actually have to start thinking about how do I want to manage this IRA now. So talk to us about some of the dates there.
Yeah, so April 1st is the deadline for withdrawing from an IRA. So this is called a required minimum distributions. It hits by the time you turn either 72 or 73.
Not there yet.
Yeah, got a few years on that.
They bumped it up to 73 recently, but there's some wonky stuff if you are around that age, so check on it. Basically, you have to start taking money out by the time you're that age.
Okay.
And then really importantly, for people who maybe haven't contributed as much to their retirement accounts as they had hoped for, you still have until April 15th to do that for this calendar year. You get a little extra grace period before tax day in April.
So max out at 6,500, right?
Yeah.
Meanwhile, if you're still someone who's weighed down by student loans, you've had a reprieve in the last few years. Now that is coming to an end, but there have been some changes as well coming from the Biden administration. Just tell us, if you are a student loan debtor, what are the key dates?
Yeah, so this could be a pretty big year for student loans if some of these reforms from the Biden administration go through. So on the calendar, at least right now, this all could change, obviously, with political winds changing, but there's going to be new student loan rules coming in July. This could really reduce monthly payments for people. So right now, monthly payments are 10% of income above 225% of the poverty line. Basically, that helps make sure that you aren't paying more than you can based on your income.
I mean, in the UK, it's all completely means tested. But I mean, you pay on how much you're earning. It's kind of mind-boggling that that's not the same.
Yeah, and so here, the Biden administration is going to reduce that to just 5% of your income. So theoretically, that will cut student loan bills for a lot of people, which is really helpful. That being said, the downside is that coming in September 30th, the leniency for making student loan payments ends. Basically, required monthly payments started back up around October 1st of this year. But the Biden administration allowed a one-year leniency program. And so that meant that people who didn't make those payments weren't reported to credit agencies and didn't have the worst effects. That is going to be over September 30th.
Brace yourself.
Claire Ballantyne. You know, many reasons I like having Claire Ballantyne in studio. Top of the list is she's a Duke University graduate.
Oh,
boom.
Yeah. I am outnumbered.
Too many UVA folks, too many UNC folks.
I agree.
So we need some more Dukies in here. So that's one of the many reasons we like Claire Ballantyne. With a great story out today on some personal finance issues on the terminal. And continuing on personal finance, you got to talk about residential real estate and real estate in general, because for many Americans, their home is their biggest asset. And boy, we've had a really, really high interest rates and a real shock to the system, but now rates are coming back down. So what does that mean for the residential real estate market? Well, Selma Hepp joins us. She's a chief economist at CoreLogic. Selma, thanks so much for joining us here. I mean, I guess the key question for me is affordability. That is really a challenge for many folks out there. Talk to us about where we are there.
Yeah, so I mean, we're seeing definitely a lot of improvement in terms of affordability, simply because you're paying much more on your cost of home ownership is much lower with decline in mortgage rates. So let's put this in numbers. You know, when mortgage rates were over 8%, and with a decline now to 6.6% over the last week, you're looking at a saving of about $300 on a $500,000 mortgage. Right, and so the more expensive the mortgage gets, the more of a savings you have. The issue really these days is, in terms of affordability, even when mortgage rates come down, is that it's really difficult in many ways to get a mortgage unless you're a very creditworthy borrower, and also you're competing against a lot of people that have cash. Or are coming down with large cash down payments. And so, you know, there's many aspects to affordability. It's not just mortgage rates at the moment.
Exactly right. And, you know, what I'm kind of thinking about is one of the key issues in the real estate market is nobody wants to move out of their house. Therefore, there's no existing home sales, or they're very, very low. And if you want a home, you got to go look for a new one. So my question is there a mortgage rate, do you think, that would kind of like be a clearing rate, if you will, where it would entice sellers to sell and buyers to buy? Is there, when you talk to, do you get a sense there's a clearing rate?
Yeah, that's $1 million question this year, because everybody is asking at what point people will give up that inventory. There's been some surveys out, and they show that 5.5% seems to be a magic rate. It's really difficult to say that that would actually happen, at least for sellers, because a majority, the median rate is still about 3.8%. So people are still locked in that rate. And they bought probably before, more home prices have gone up some 40%. So when you think about how much we've seen, how much appreciation we've had over the last few years, it's been 40%. So that's a lot to consider. It's not just your mortgage rates you're giving up, but you're also giving up the much lower cost of a home. So, so that's, that's kind of, I think, what's going to keep people put for a little while.
What is sentiment like right now? How many consumers out there think this is a decent time to buy?
Oh, not many, not many. And it's actually that sentiment has been on a decline, at least until, we'll see what happens in next month or two with the decline that we saw over the last couple of weeks. I think that will improve the sentiment. The other thing is, we are going into spring home buying season. That tends to see a better sentiment, and people do tend to come out in a spring home buying season. And, if you remember what happened last year, mortgage rates peaked in November, and then they declined coming into spring home buying season, and we had a really good season, at least in terms of how many buyers came out. The problem was that sellers didn't come out, and so we saw a lot of home price appreciation. That actually may happen again this year. We'll see more buyers than sellers. It will put pressure on home prices, and that tends to challenge affordability again.
Hey, Selma, one of the challenges I know out there is that while the builders and their home building company stocks have just ripped in 2023, done really, really well because there's so much demand out there. But I'm wondering, what are they building? Are they just building the next McMansion around the corner, or are they building the homes that kind of starter homes that young people need to get into the market? Do we have a sense of what's coming onto the market in terms of new construction?
Yeah, it does feel like they are tending to move towards more traditional, smaller homes. In the data we've seen recently, the size of a home declined by some 10% for 2020 builds versus 2023 builds. So it does seem like they're building smaller homes. They're trying to adjust to who their buyers are at the moment.
One thing, I suppose, while consumers out there don't feel like it's a good time to buy, there are people sitting pretty. There are people who have looked at the value of their home equity and probably felt a little bit more buoyant and stride in their step. Who have those people been? Where have been benefiting the most of late?
Yeah, that's the really interesting stat. At CoreLogic, we do a home equity report every quarter, and in the last report, we saw home equity increase to about $304,000 on average per mortgage borrower. So that means across country, right? On average, people have over $300,000 in equity. Now, that's much larger in more expensive markets and more markets that have seen more appreciation over time. So one market that leads, one state that leads is Hawaii. That's over $600,000 on average in equity, followed by California, about $580,000. So some of that, what's interesting about this is particularly California, for example, or Washington State, those are also the markets where we see a lot of out-migration from. So those folks not only tend to have higher incomes, but they also have more of that cash saved up. Right. And so that actually tends to feed into home price appreciation in other markets that they're moving to.
Hey, Selma, interesting development. A bill introduced in the House and Senate would prevent hedge funds from owning single-family houses in the United States. From your perspective, how prevalent has Wall Street and institutional investors been in buying up residential real estate over the last several years?
Yeah, much more so during the pandemic. Before the pandemic, we saw about 18% of single-family homes being bought by investors, and that share increased to about 28% at the peak of the pandemic, but actually it remained there. The reason is that overall sales are up, so as a share, it does remain elevated. But one thing to keep in mind is that it's mostly small investors. Over 50% of these purchases are actually small and medium investors. Large investors, the institutional investors that we're worried about, they actually comprise pretty small share of overall purchases of single-family homes.
Salma, it's great to have you from CoreLogic.
Thank you so
Chief
much.
Economist, Salma Het, joining us on all things real estate, whether it's hedge funders, whether it's us mere mortals trying to be buying a home. And it really does impact so much of consumer sentiment in terms of where we're going. And that 5.5% number, Paul, it keeps coming back, doesn't it?
It does. It does. It seems to be what folks feel like might be a clearing rate. And I suspect you're going to get there sooner rather than later. At least that's what discussions I've been having with my mortgage guy, but we'll see.
Not that you're eyeing refinancing.
I am, but I need a four handle. I might be too aggressive here.
6%, it's pretty painful. Meanwhile, though, we're going to be dipping into all eyes on a little bit more what those hedge funds have been up to and the venture capital within them. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
All right, we're back. Bloomberg Markets, Caroline Hyde, Paul Sweeney. We're live here. We're simulcasting. That means we're going on radio and television. Here we're doing it all from the Bloomberg radio studio, which is a phenomenal radio studio, by the way. So thank you for that. My Tiger Global is not the Tiger Global of what's happening out these days. Mine was kind of Julian Robertson and that kind of stuff. But these are the Tiger Cubs. But there's some movement there. There's a lot going on with some the folks at Tiger Global Management. Shonali Bassick joins us because she covers all things Wall Street, and she's on top of this. So Shonali, talk to us about what's going on at one of the bigger hedge funds out there, one of the more well-known hedge funds out there, Tiger Global.
Yeah, remember Tiger Global was once a $100 billion firm back in 2021, and they had really pushed heavily into private investments. Typically, as we know, hedge funds has been known for trading liquid assets, stocks, bonds, commodities with leverage. But now what Chase Coleman and Tiger Global have really done at scale with many others, like Dan Sundiam's D1, like Lee Ainsley at Maverick, what they've done is they've pushed so far into that private investing world. But at Tiger Tiger Global, which was really a behemoth in that world, you really saw a lot of those bets start to sour in recent years. And so what has that led to? It has led to assets at Tiger really dropping quite meaningfully, down to $50 billion as of September 30th, as it faced losses, valuation cuts in a lot of its private investment portfolio. Remember, it had pushed into more than 750 different startups since they really began doing this. And remember, they had some really, over 20 years really, they've had really solid wagers as well in that time. You still saw them get into ByteDance, JD.com, other big high flyers across the world of venture capital that became massive tech firms. But the boom times of the last couple of years have posed a really large issue. And now you have Chase Coleman, Tiger Cub, head of the firm, really looking to turn that ship around.
It's kind of ironic, isn't it? Because basically the boom times were kind of pushed by companies like Tiger Global becoming these crossover investors, coming in, writing enormous checks. I mean, it all kind of goes back to SoftBank to begin with, and their own $100 billion fund. But they then did elevate valuations, and then that all came crashing down when rates started to go higher. What does Chase Coleman coming back to sort of helm the VC arm really mean for investors right now, Shonali?
It's a big open question. There are some investors that like that he is taking greater control of the issue because of how sour things have gotten in the last couple of years. Remember, like I said, this went from $100 billion to $50 billion, this firm. So Scott Schleifer was a very senior executive at Tiger Global, leading this charge in many ways. You even had Chase Coleman say Scott really helped build this crossover model, moving from public to private for many hedge funds. Yet now you have Scott Schleifer moving into a senior advisor role. And what's amazing is you have people privately telling our own Hema Parmar over at Bloomberg that perhaps investors in the latest venture fund over at Tiger Global should be able to really get their money back. They should be able to cancel their commitments because initially, and remember, for big funds, key man risk, if a person is no longer strongly at the helm, then can you trust that the performance will be the same moving forward? According to the people familiar with the matter, though, we should also say that Tiger Global has not been fielding those requests from investors, so it hasn't gotten to that point yet. This is, again, a business that has had a net IRR of 20% over 20 years. But the most recent years and pivot from here in a higher interest rate environment where the venture investing landscape is not the same makes the calculus very complicated for now Chase Coleman, who is taking greater control of that.
You know, from Hema's reporting, it looks to me like Tiger did the absolute right thing in terms of structuring this business. They kept their venture business, which has long-term capital, sticky capital, separate from their hedge fund and their long-only funds, which can be withdrawals, I don't know, quarterly or something like that. That's the right structure. So the only thing that's happening here is mark-to-market risk. Everybody on Wall Street's marking down in 23.
Yes, fine,
What's the
maybe,
big deal?
sort of. So here, like the thing that you're saying makes sense. However, you have to recognize that for many years, even heading into the boom times, a lot of hedge fund investors were saying, what are these guys doing? Do they know what they're doing? They're traditional hedge fund investors. Should they be playing in private assets? Private equity and venture capital have very different risk profiles.
True.
And if you think back to 2008, there was another flavor of a similar situation where you had a lot of hedge funds getting into illiquid assets and then stuck with those illiquid assets when the market turned. Now, it wasn't that severe this time around, but some of the markdowns are incredible, Paul. You think about 90, 95% on some of the startups that they bought into, they've had to mark down. And so, to your point, perhaps the structure was cleaner than pre-2008 hedge funds doing illiquid investing, but still there are so many questions about whether these are the right investors in that industry. And you have a lot of the traditional VCs. Caroline, you remember this. They were all complaining. The hedge funds are getting in. They're driving up the prices. Do they know what they're...
That's good. I remember that.
Yeah, so I mean, I would like to say that there has not been warning signs heading into this last phase of this bubble. Certainly people were concerned about the way that these hedge funds have been crossing over. And now it leaves more existential problems. You and I were talking to Alana Weinstein yesterday. The problem that these firms have not been able to meet their high water mark over the last 2 years years. And really, yes, this year has been better for many of these firms, but the last 2 years were so bad that the one good year is not really making up for the bad year. And the management fees are on smaller assets, a smaller amount of assets. So there's less money to go around to hire star talent. And remember, this is a firm that had outbid everybody, let's say. Let's just be dramatic about it.
They outbid them on the investments, they outbid them on the talent.
Totally.
I mean, it's interesting, isn't it, that actually now they're looking for some liquidity in the secondary market, and we've been talking a lot about how secondary market might be pretty active in 2024 because the IPO window doesn't seem completely set to open. M&A as well, really limited given the amount of regulatory oversight. But you've been looking at M&A winners for this year as well. Just give us a little snapshot of, look, for the deals that could get done, that weren't kiboshed, which companies did well?
Yeah, it's interesting because you and I used to talk so much about the tech industry being so exciting and really helping out the investment banks in terms of league table performance. But this year, think about the top 2 out of the 3 deals.
Health, was it?
It's energy. ExxonMobil, Chevron, and Hess. And what that has done has been a very big boon for Goldman Sachs. Goldman Sachs did try to build up its practices, and it did build up its practices around alternative energy. But in that time, in those times of hibernation, let's call it, they held strong to their traditional energy practices as well. And what it did is it put them on 2 of the largest deals of this year, Exxon and Chevron. By the way, that Chevron-Hess deal, David Solomon, the CEO of Goldman, was also on himself. And so that has now made Goldman the #1 advisor on mergers and acquisitions by focusing on this old, staid, and frankly out of fashion industry for a long time, made them the #1 advisor in mergers for the 7th year in a row.
What I like about year-end, one of the things I like about year-end is you're reporting on the league tables, because I'm a league table person. For a few years, that was my life, manipulating league tables to make us look good. What I found, just really exciting, is we have 2 boutique firms, Centerview and Evercore. They're in your top 10 list at number 6 and 7, beating like UBS and Barclays.
It is incredible, this rise. Remember, Credit Suisse, your alma mater, used to be a top 10 firm in it day in, day out, right? But now what you have is Credit Suisse no longer in the market. UBS absorbing Credit Suisse, clearly a little distracted. They've fallen down to number 9 on the league tables. Centerview and Evercore, these are firms with a fraction of the employee count that you have at a Goldman and JP Morgan, yet Centerview and Evercore have more than doubled their market share this year. And it's incredible because I spoke to the Evercore CEO, for example, John Weinberg, whose family, frankly, ran Goldman for most of its
Weinberg family, absolutely.
Totally. And he's saying now that, listen, we have come in at number 4 in terms of revenue on merger advice for the last couple of years. And now, in the last quarter, they came in at number 3. Can you imagine? They beat Morgan Stanley in the most recent quarter on the fees taken in by merger advice. So you have these boutiques fighting hard, hiring hard, paying top dollar for those talents. And now, after a record year of hiring for Evercore, they're hiring more. And so, remember, they hired a record amount of senior managing directors in a year where deal volumes were the worst since 2013, in a decade. And so, if you thought that this was a tough market for Wall Street, yes, it was. There was still a significant types of hiring. And next year is certainly pointing to the chance for hiring to come back again.
Yeah, if I'm an M&A banker, why do I want to have to worry about my bonus being impacted by some knucklehead losing money trading the yen in Singapore? So if I go to these boutiques, it's really eat what you kill type of thing, and it's really focused on M&A exclusively. And for a lot of those bankers, it makes a lot of sense, and we're seeing it in the numbers. So good stuff there, Shonali Bassick, covering all things Wall Street here, bringing us this story on the year-end league tables. Fees are down, but they're down pretty substantially, but the bankers still fight for the league tables and the market share. So it's good to see that reporting here. S&P 500 off 0.4%, the NASDAQ off 0.7%. We're going to have more coming up. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management. Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
p.m. in the fine city of New York. It is the last day of trade before the new year. Paul Sweeney, Caroline Hyde going cross-platform. We are simulcasting on radio and TV. Checking in on those markets. We're bouncing off of our lows, and we're currently seeing actually for the week, the S&P 500 is still up by 0.2%. And indeed, that would make its 9th straight week of gains. Longest winning streak, Paul, since 2004. But everywhere else is a bit of a damp squib. We're off by about 0.7% on the NASDAQ for the trading day. We're off of those record highs in the NASDAQ 100. Even the Dow's off of its record high. We're off by 0.25%. So a little bit of risk aversion as we creep into the end of the year. The Russell is off by more than 1%. Crude, though, still managing to be up above $71. But remember, we are down about $8 from where we started at the beginning of the year. And I'm looking at some little tension creeping into the funding markets. We were talking about this with Alex Harris yesterday. The SOFR, so this is the sort of overnight lending rate, funding rate, basically trying to see whether or not we have any tension in the overnight funding areas. And we are at a new record high, 5.4. So maybe a little bit of concern about how suddenly these companies are trying to just clean out their balance sheet to ensure that they're in the right place at the right spot just before New Year's Day.
All right, absolutely. Let's get a sense of what's happening in these markets when we look ahead to 2024. Max Gauckman joins us. He's the Senior Vice President at Franklin Templeton Investment Solutions in lovely San Mateo, California, just south of San Francisco by the airport on the water. Great little campus there. Max, thanks so much for joining us here. First, I'd like to stick with 2023. and ask your thoughts on what happened here over these last 8 to 9 weeks. What's your take on this market move?
Yeah, I mean, I think it made sense that we saw a rebound like we did. Earnings really continue, I would say surprise, but really continued to surprise to the upside. Margins actually were very resilient. That was the marker for me because I was a bit bearish before the start of the last earnings season. And then we switched to a more risk-on stance. And it was really those margin resilience that helped us. And then, of course, we had some signaling and eventually the confirmation from the Fed that they're shifting down from a more hawkish position to a more, neutral one and likely will turn dovish. And I think that just really carried us through year-end. So not so much a Santa Claus rally, more a Jay Powell rally.
And is Jay Powell going to keep on giving here in the new year? How do you think about going forward?
So here I think we're a little ahead of ourselves. When I look at interest rate markets, we're projecting a full cut by March pretty much. I think we're going to have to wait a little bit longer, wait till May. And I think what's going to be really critical for maintaining positive momentum in the first quarter, aside from earnings, is going to be the Fed really changing investor expectations very gradually to get them comfortable with the fact that they're just going to have to wait a little bit longer for that full pivot.
Max, what's so interesting about your own CV is that you're on the research and you're contributing to the cross-asset and global equity research. You're in the investment committee over at Franklin Templeton Investment Solutions, but you're also driving the digital transformation of the business. So you're probably the person to ask about digital transformation more broadly within equities as well. I mean, a lot of the market rally was front-ended in the tech world. Are we likely to still see AI and the exuberance around that driving equities in particular next year?
Well, look, I am personally very bullish on AI. I mean, I've changed a lot of my career from more of a traditional quant portfolio manager to someone who's a lot more aligned with technology. So with that, asterisk, I want to say that we really need to see more of an ROI on AI. And the Magnificent Seven really rallied. I think with NVIDIA, there's a lot of reason for that because NVIDIA and other chip makers are going to see increasing demand. Makes me look at, for instance, TSMC and Samsung, really, the EM Asia ex China markets more favorably. But when I look at the rest of the tech sector, there really hasn't been something that can show that there's real revenue to be gained from AI near term. Now, as we look, 3 to 5 years out, I think that changes. But in 2024, I think there's going to be a disconnect that becomes apparent between investor expectations and what companies have promised but haven't delivered yet when it comes to artificial intelligence.
I like that you bring in sort of the companies, the chip makers that are Asia ex-China. And of course, the ongoing narrative of 2023 was China-US tensions largely in the field of technology and clamping down on chip exports in particular to China. Where do you see geopolitics playing into investment decisions? Globally speaking, is it still all about US stocks? Is it about equity distribution more broadly? Is there opportunity with valuations being lower in Europe and Asia, for example?
Yeah, I think it's a good question. It's a fairly complex question. So let's take a quick tour around the world, starting with the US, where, yes, I think the US remains attractive. I think there may be more opportunities for value to close the gap with growth, especially if some of those geopolitical flare-ups kick in. I mean, we saw the defense stocks rally over 20% since October 7th, once the conflict in the Middle East broke out. I think geopolitical flare-ups are going to continue. And, we've lived in a very peaceful period for a very long time. I think we need to adjust to the fact that this is not the world we used to live in, unfortunately. And there are going to be opportunities on the investing side because of that. When I look at Europe, it looks cheap on every measure. I think it's cheap for a reason. I do believe it's very easy to get caught in a value trap there. Christine Lagarde is a very different central bank governor than Jay Powell. I think she is going to be more determined. And also when we look at the earnings picture there in Q3, very different from the US, 10% decline in earnings. A lot of companies issuing negative guidance, talking about waning consumer demand. So that doesn't look that great. And then when we look to Asia, like I mentioned, I think there are more opportunities there. especially in countries that are responsible for a lot of the demand for chips. And lastly, Australia has seen a really strong rebound. I don't know if that's going to continue into the new year. I just don't see the commodity demand really giving them the breadth that the companies there need to do well, not when growth is slowing down across the developed and emerging markets.
Max, I'm just looking at the S&P 500 earnings estimates out there. I'm looking for, kind of 12% growth in 2024. Are you comfortable with that kind of growth out there, or do you think there's some earnings risk that could be a little bit of a headwind for this market?
I think there is earnings risk. And, we always see very ebullient, or not always, but often see pretty ebullient expectations when, also the consensus is for a soft landing, kind of, bypassing a recession. And I think it's sort of similar to what I mentioned earlier about the Fed, where if analysts start walking that back gradually, I think we can get through it of generally positive momentum. But if analysts continue expecting these, really abnormally high earnings, I think that is going to be a headwind to equities coming through. So really, this is all to say it's a lot more uncertain than perhaps the consensus estimates would lead us to believe as we head into the new year.
All right, Max, let's get the important stuff here. I understand you're an amateur race car driver, so 2 questions. What do you race, and maybe more importantly, where do you race? Hopefully not the streets of San Francisco.
Definitely not the streets of San Francisco, maybe in my very younger days. But no, I race a spec Ford with Sports Car Club of America. I actually just started a new league, so really excited for 2024 with that as well. Hoping to get competitive, and we'll be racing across tracks all the way around California, from Thunderhill to Sonoma to Chuckwalla.
You should check out Laguna Seca. It's my backyard.
I just had a test day there last weekend, and it was wonderful, except when it rained.
Good stuff.
Okay, so when you're not hurtling round corners in beautiful contraptions, where would you be if you had to just pick one area to be allocating into? And obviously no one would ever say doing that because we should be all diversified. But if you had to sort of go over in some particular area, where would it be for 2024?
Sure. If I had to go over, I would really look at emerging markets. I think emerging market equities specifically, and again, like kind of those chip-making regions look really attractive. But, I also think the T-bill and chill trade is going to be alive and well, especially as the curve starts to de-invert. So, there's I have to be a little diversified being a multi-asset investor. So those are my 2 picks.
You're the second person today that's mentioned emerging markets. And my question, I'll ask you the same question. How can you do that if, given the uncertainty in China and the subpar growth in China, how does that kind of factor into it?
It's a really great question. It's one we spend a lot of time on. And what we found is that when you look at the rest of EM, it's actually become less dependent on China over the last several years, especially post-pandemic. And so you can have a view that's positive on emerging markets ex-China. And, you can look through some of that slowdown that we are definitely seeing in the Chinese economy, especially in the housing sector.
All right, Max, great stuff. Really appreciate you taking the time on the last trading day of the year. Max Gauckman, Senior Vice President of Franklin Templeton Investment Solutions. They're all over the place, but Max is based in their HQ, which is San Mateo, California. All right, Caroline, Rich Go. I don't know who created this function, but I hope they got some award here, because and it just lists the most wealthiest people in the world. And what's interesting about this is the methodology. Like Bloomberg, everything is data driven, and I believe this is kind of the best quality of data and the actual best calculation out there and it's become the default list around for most folks that do look at this stuff. Elon Musk, not surprisingly, #1 on the list, $232.4 billion. Yeah. That number in and of itself is interesting, but the other interesting number for me is what happened to him this year. He gained $95.4 billion. That's a good year.
That's a good year. And remember, he actually, at the beginning of the year in February, he was Oh, poor soul.
Yes.
Number 2 on the list,
Yes.
behind Bernard Arnault, who, of course, has made his fortune in French luxury with LVMH. But he's back in the number 1 spot ever since about the end of May. I mean, we all worry about the money that he seems to have flushed on Twitter, now X, but 44 billion versus a 95.4 billion net addition this year kind of pales into insignificance.
Because you know why? Perspective matters.
Yeah,
So you put that in
perspective matters, context matters.
Yep.
Meanwhile, though, what's interesting is Jeff Bezos, he's still managing to be there basically like neck and neck with Bernard Arnault as well. He was up more than 70 billion. Mark Zuckerberg did incredibly well. I mean, these tech companies really did well. Look, the thing that gets me about Rich Go, there ain't many women on it. So I highlight a few women who have done incredibly well. One of them is just making big moves in the world of sports. Dallas Mavericks, now majority owner, buying $3.5 billion stake there. Is, of course, Miriam Adelson. She's 78. She, of course, took over the casino operator Las Vegas Sands after the death of her husband Sheldon. But there's also Francois Bettencourt-Myers, who is the heir for the L'Oreal fortune. L'Oreal has absolutely crushed it this year, fortune surging for her 40% because of the shares of L'Oreal that climbed to a new record high.
Yep, absolutely. And some of the usual suspects, as we'll call them, Warren Buffett's on the list at number 10 at 120 billion. He was up about 12.9 billion this year. And the name that you kind of forget about, Steve Ballmer.
Yeah,
I mean,
Microsoft.
He's number 5 at
Thanks, Satya.
100. Yes, exactly right. You're so right. And that's why, like, Satya Nadella, in my mind, and I bring this up with some tech folks, he's kind of almost flown under the radar of the tech greats.
Oh, yeah.
I mean, we all think, when we think about it, we think about Elon Musk and, you know, so on and so forth, and Larry Page and all those people. But Satya Nadella turned around a company that a lot of people had almost left for dead as a growth story.
Yeah.
And just reignited it. Just extraordinary.
Just injected AI, got into cloud at the right moment, just pivoted when many felt just time and time again Microsoft had missed the boat, whether it had been shift to mobile, whether it had been all these moves that Steve Ballmer had sort of slightly in hindsight not managed. Satya to the rescue. Others that didn't do so well this year, maybe Masayoshi Son, maybe Carl Icahn. Let's see how he improves for 2024. This is Bloomberg.
Where do you think the future of technology is going in Silicon Valley and elsewhere over the next 5 or 10 years?
Technology is an underpinning. It's not its own industry. It is a part of every industry, and it's actually going to increase productivity and actually make our lives better.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg.
Welcome to Bloomberg Radio TV simulcast joy that is the final day of trading here on a Friday. Paul Sweeney, Caroline Hyde. We are leading you up to the close. And look, from a stock market perspective, not as buoyant as it has been. We're coming off of our lows. We're only off by 0.4% on the S&P 500. We're still up on the week, Paul, and it's still 9 weeks of gains.
Yes.
And people extraordinary gains throughout the year. Maybe a few people looking to put a little bit of extra money to work in 2024. I mean, we're hoping the consumer remains resilient. We're thinking maybe they spend a little bit on their vacays. You got a vacation plan coming up in January?
Heading down to Aruba.
Oh, sounds awful.
Yeah, it's just, we kind of found it last year, and we said, we'll keep going back. It's a good place to go. It's a little bit farther than your typical Caribbean island, but we kind of feel like it's worth it, so.
Well, people with kids like me don't travel that little bit farther,
yes,
so
I know.
think you're
Those
smart.
days
you avoid us.
Yes.
Meanwhile, I dragged mine across the pond in the UK as I decided to avoid a transatlantic trip for Christmas, and instead I go drag them back over the MLK week. But I'm not cruising.
You're not cruising.
Not cruising for a bruising. Meanwhile, though, some people are, and it feels as though we had the CEO of Carnival join. I thought it was interesting. He's also the Chief Climate Officer, and I didn't know whether the CEO and whether those two things were always...
They're really trying to reduce the carbon footprint of the cruise industry, which is, they admit, huge.
Yeah, and so the fact that they have to have a separate title under the same person is quite extraordinary. But he seemed pretty, pardon a pun, buoyant on the direction of travel for him, right? It felt as though he felt people are looking to spend in 2024.
Yeah, it's kind of revenge travel's over. This is real demand.
Yeah, this is people actually getting comfortable, wanting to get back on those cruises. Let's have a little listen to the CEO of Carnival earlier on Bloomberg Surveillance.
2023, we wrapped in November, on November 30th, and the one word that we like to use as a summary is record. We had record demand, record yields, record pricing, record bookings, forward bookings, record onboard spending levels. So really across the board, our business has really thrived in 2023, and we expect much more in 2024.
It could continue, because you're such a great gauge of how customers are feeling. You have several brands, but you really kind of speak to, the everyday U.S. consumer, if you will. And you just have a great read on it. Are they continuing to spend? Are they continuing to do advanced bookings? And then once they're on their ships, Josh, continuing to spend as well?
Yeah, that is exactly what we see. As a matter of fact, our Q4 was, from a pricing standpoint, the highest all year. So it's accelerating; it's not decelerating. And then when we look forward, we're actually 2/3 booked for all of 2024 already.
It's nice visibility.
It's not too bad. We're about 10 points higher than we were last year, and on top of the ticket bookings, we've actually started pulling forward onboard spend. So we have more or less about a third of our onboard spend being prepaid in advance. So we have a really good amount of visibility, and those booking trends, they just haven't slowed down. Every quarter this year, people expect that it's gotta slow down. We're gonna see something. The consumer's gonna get impacted, and the fact is, with our business, we haven't seen it. It's record after record. As a matter of fact, we just ended the 2 weeks of Cyber Monday and Black Friday at more records, and it's not just coming from one brand. It's not coming from the United States. It's global. It's with our global portfolio of brands, which is really, really encouraging.
Do you think we're moving, good morning, good to meet you. Do you think we're moving from many CEOs similar to yourself that I've sat with that run global airlines and global businesses have said, we've lived through a period of revenge tourism. We were all locked up for a period of time. This is something, we had this parabolic reopening and you had a parabolic rebooking. Are we evolving into some kind of new cycle? You say there's no end in sight in this demand. So if we've ended revenge tourism, how would you describe the next evolution?
Yeah, that's a great question. So we don't think this is revenge anymore. This is not pent-up demand. It's 2 years on from when we really got back in full as a corporation. This is people who have decided what's meaningful for them. How do I want to spend my life? And experiences are what they're looking for. Unforgettable memories and creation with friends and family. And that's exactly what cruising has to offer.
And that's what I sat down with the Accor CEO and he said, look, I haven't got enough hotel rooms and I haven't got enough high-end staff to help me run this business, which then takes me to the cruise is the high-end hotel, but to what extent are those packages off ship and onshore, those additional spends, are they critically important to the expansion and the turnaround from the loss that you've had? Do they add incrementally or significantly?
So, when we think about our business, we're a little bit different from when you're looking at hotel companies. I'm staying in a hotel in New York, and I won't tell you which one it is, but I'll tell you the service is not very good. And we've learned how to live with that as a society. It's almost a tacit acceptance. No, we should not. No. And the cruise industry, our brands did not deviate from service level. Our guests have high expectations, and we aim to exceed them. We do not close off floors. We do not shut areas down. We do not skimp on the services that we used to offer. It is full steam ahead, and that's what people expect, and that's what they're willing to pay for, and that's what we're seeing.
And let's talk a little bit about the fact that you are a global brand, of course, a global company that goes many places in the world. I don't need to tell you that the geopolitical landscape, very fraught right now, 2 hot wars, and of course, conflict in the Red Sea. Has that impacted at all where you can go? And are you seeing any inflationary pressures from some of the things that we're talking about here?
So the second question is no. We haven't seen anything of note. Obviously, we pay attention to crude prices, which is a good barometer of a lot of things. With respect to the impact on our business, we had about less than 1% of our business touching Israel in one way or another. Not necessarily home porting, but it might be one transit stop on a world cruise or something of that nature. We made changes some time ago. We actually don't have any ships transiting the Red Sea area for several months. And so obviously safety first, and we have mitigation plans should we need to adjust where those ships would be transiting. But as of now, we're in a watch and learn mode.
Let's also talk about your bond book, because it was interesting seeing just last week, actually, S&P coming out and upgrading Carnival, not quite back to investment grade territory, but you're getting closer.
2 notches higher.
2 notches higher. On earnings day, actually, you think back, and the chief financial officer of Carnival said that there's a real possibility that Carnival will come back to the debt markets in 2024. Where's your current thinking on that, and what would actually bring you back to the debt market?
Well, really, the only thing that would bring us back to the debt market, as far as we can see, is if there's opportunity to refinance on more favorable terms.
So lower rates.
Yeah, lower rates. We're not, or managing our maturities, but we're not looking to lever up. As a matter of fact, as you said in the intro, we've managed to cut down our debt load by about $5 billion so far. And we expect much more of that as we go forward. You know, that's priority 1, 2, and 3 when it comes to our capital structure, delever.
Hey, you know, one of the things, and it kind of ties together geopolitical, but also kind of, you know, where you're thinking about growth. Saw a story, I think it was today or in the last 24 hours, that the first domestically built ship in China getting ready to hit the high seas. But it's a joint venture. You guys are involved in this. And I think about how important China is for you guys, but also geopolitically concerns about China, its ambitions with Taiwan, and whether or not there's going to be some problems there down the road.
Sure. Well, we're very happy for the folks at the China JV. We actually unwound the JV earlier this year.
You did?
We did. So we've been providing shipbuilding expertise support for them, and we were very happy to do that. And we're
the
very
story
excited
still says you guys are involved, but go ahead.
Well, that could be how we're involved at this point. But from our perspective, we got a portfolio of world-class brands all over the world, and that's where our focus is. You know, it's great for the cruise industry that China has opened up, and it will be opening up for international cruise companies. We're not going to be one of them that's going back in. We've got our assets where we want them. We've changed our asset strategy. We've moved ships to different brands to accommodate the change in China, and they're doing very, very well. So we'll take a wait-and-see approach on that as well.
All right, that was Carnival CEO Josh Weinstein speaking with the gang from Bloomberg Surveillance earlier this morning. And boy, that's about as bullish an outlook as I've heard in a while from a consumer-driven company. Again, seeing record kind of bookings, and that's what investors look for, is the forward bookings. And it looks pretty darn good at this point.
Yeah, eclipsing it time and time again. And this is why it is so hard to call this economy, to call this market, because every time we think that people are depleting their savings from COVID, their stimulus checks, the fact that the consumer is going to be a little bit more of a tough spot, and then you get Carnival Cruise coming on and saying that we're at record bookings.
Another anecdote, I just booked a September trip to Ireland to go see my peeps. And the week we wanted, we had to act now, or we were going to lose it. In September.
What?
That's the demand.
In Ireland?
Exactly. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
All right, welcome back to Bloomberg Markets. We are Caroline Hyde, Paul Sweeney. We're simulcasting, that's what they call it. Bloomberg Radio, Bloomberg TV, so you can get us anywhere you need to. Boy, a rip-roaring end to the year for sure, making the indexes all look pretty darn good here for 2023 when we look back. But you look back a year ago, and we were reading all the outlook pieces for coming off of Wall Street about what to look for in 2023. There weren't too many people that predicted this. And we wrote a story about it. Wall Street's best and brightest flopped once again in 2023. That's all you need to know. Alex Semenova, she's partly responsible for this story. She joins us here in our studio. Alex, take us back a year ago. What were we hearing from some of the Wall Street forecasters about 2023?
Yeah, so the overarching view going into 2023 was that a recession would be inevitable. Everyone was kind of game planning for that. And it's always very challenging to be a market forecaster on Wall Street. Anything can happen, but particularly over the past 2 years in this post-COVID economy that has really defied expectations and all traditional models that people have used in the past to make calls. And the three big calls going into 2023 were sell U.S. stocks amid the expectation of an economic downturn, buy bonds on the expectation that a recession would lead to a rebound in bonds from last year, and buy Chinese stocks as their economy opened up after COVID. That was expected to propel the nation's stocks, and of course none of those calls played out. When it comes to the equity market, the S&P 500 is now nearing a record. It's a little bit down today, but still pretty close after a more than 20% gain this year. Bond yields are set to close the year roughly where they were at the end of last year. And then, of course, Chinese stocks experienced a rout this year amid a deepening real estate crisis and fears of deflation. So it's making life very awkward for those who sell their calls to investors around the world.
I've never seen the consensus as wrong as it was in 2023 is a great quote in your piece by Andrew Peace. He's over at Russell Investments. But to be fair, let's call out, unfortunately, Mike Wilson, who was a bit of a perma bear, really came out as on top for 2022, and that bearishness just didn't bode well for 2023. You call out some others, at Bank of America, who got it wrong in terms of the Treasury bond yield view, and Goldman getting the Chinese asset call wrong. Let's dwell on those who got it right. Anyone who called some of this bull market right.
Yeah, so some of the people who are kind of seen as ever optimistic, as perma-bulls, that's the term that you called them, actually came out vindicated this year, but they were wrong last year. So thanks Tom Lee over at Fundstrat, Binky Chadha over at Deutsche Bank, they went into the year expecting a big rebound in stocks. And what they said was basically the kind of route that we saw last year is usually followed by solid gains in the subsequent year. If you go back to history, very rarely have we had 2 consecutive years of double-digit losses in U.S. equities. The last time was in 2002, and it's only ever happened 5 times in history. So when I ask them what it is that everyone else got wrong, they say that usually we do get a rebound after what we saw last year, no ifs, ands, or buts. But then you ask some of the people who were wrong, they say that no one could have anticipated the AI frenzy that fueled stocks this year. They say that
weight loss drugs?
Exactly. There were a lot of factors that a lot of people couldn't call.
You know, it's, in terms of the fixed income, I kind of call it a win year. I mean, compared to 2022, when double-digit declines, historic declines across all fixed income, this year, you know, I mean, kind of mid-single-digit positive returns, not so bad. And the U.S. corporate high yield up 13%. I did not see that coming. So a little bit better performance here in fixed income.
Yeah, definitely. This fourth quarter rally kind of saved things from fixed income. It would have been the 3rd straight year of bond losses.
Absolutely.
When we are, therefore, dare we make any forecasts whatsoever, but set us up for 2024. What are, therefore, the learnings from 2023 and pushing us into the next year?
Yeah, so definitely it has been a year of reckoning on Wall Street. But interestingly, you've heard some headlines perhaps about some firms coming out and saying that they see the S&P rising to 5,000 next year or even topping that, a little bit more optimistic than they were going to last year. But the consensus view tracked by Bloomberg stands at about 4,800, which implies little to no gains from the level that we're at right now. So there's still some hesitation on Wall Street about kind of turning to a fully optimistic view. A lot of people say that we do need that landing. We do need some sort of downturn to happen before they turn, or we need some sort of big growth catalyst to spur stocks before they can change their outlook.
Not sure if AI is going to be that once again. We'll see. It's so good to have you with us. Alex Semenova joining us. A great big take of the day of how to set yourself up into 2024. We're going to keep the conversation going. Someone who knows a thing or two about forecasting, more in the economic department, started his career over in 1980, the economics departments of my one and only Bank of England. And of course, he's now here based in New York at a full-service broker-dealer, which is Breen Capital. John Riding, it's great to have you in the house. Thank you for coming.
Thank you.
So, do you in any way want to try and forecast what 2024 looks like from an economic perspective? Because no matter what the recessionary outlook was for 2023, we all kind of got it wrong and we managed to get some sort of soft landing, it feels like.
Well, I think it's a little early to say that we've had the soft landing at this point. Our take on the recession was that it was inevitable, but it wasn't imminent. Mm-hmm. And there are reasons to have expected this economy to have stretched out. Because when you're wrong, you say, well, why is it what we're wrong? Well, there was reservoirs of support. One was the reservoir of excess savings. And despite your comment earlier on the pandemic money, the stimulus checks are running out, have run out for many people. The savings rate is below where one would expect. And so that's one reservoir that's stretched out. And another reservoir that's stretching out is this unprecedented pool of unfilled vacancies, which meant that the labor market didn't lose traction. Mm-hmm. If people lost a job, they found another job. If a company may have thought of cutting someone, they look at all the vacancies and say, well, maybe I can't afford to let this person go, I'll hold on to them. Now that adjustment's taking place. So that's pushed things out. But to have gone from an interest rate essentially of 0 to one of between 5.25%, 5.5%, to have had inflation decline the way that it has declined. And if we avoid recession completely, it will be an unprecedented event. And none of us want to forecast unprecedented events. And it's interesting, it's not untypical for people who forecast recessions to go back on the recession forecast and then for the recession to happen. And there's still indicators which suggest that we may be close. And we have had sectors in recession. Manufacturing has been in recession. Chicago PMI continues to be ugly in recession in December. The housing market's been in recession, though house prices did not decline the way that maybe some people had expected. And partly that's because people had such a reservoir of equity in their homes, very few distressed borrowers. Everyone was locked in at very low 2.5%, 3% mortgage rates. So there are good reasons why things have been stretched out. But I think it has been pushed into 24. I don't think at this point one can say the recession risk has passed and it's a soft landing, because after landing comes takeoff. And I think that there is certain parts of the economy that still have to adjust to rates.
John, what do you make of this labor economy? It's befuddled me all year how strong, resilient it's been, and I'm not even sure what labor hoarding is. I don't know of any company, any business that's hoarding labor, but maybe that's the thing. Why do you think it's been so strong?
I think it's very easy. It's been the pandemic. Just because the pandemic is behind us doesn't mean the effects of the pandemic are behind us. So you had a lot of people who left the labor force or who said, hey, I'm going to look for a better job. You had, as a result, a buildup in a record number of positions that couldn't be filled, to the point where there was 2 unfilled jobs per unemployed person looking for that job. That is unprecedented in the economy. And that's just a result of the dislocation that has taken place. And in fact, one of the remarkable things about the labor economy over the last 12 months is the labor force grew by 2.3%, where in demographic terms, it should have been more like a 0.3 to 0.5%.
Was that women coming in? What was?
It's partly women coming in. There's no doubt about it that the ability to have hybrid working, or to have employers being comfortable having a number of jobs conducted from home, the work from home thing, is being beneficial to women who maybe they're at the life cycle stage where they want to look after the kids. They don't have the time to commute back, and they can keep an eye on their kids while doing work. So I think that's a factor. But I don't think it's just that. I think it's something that we're going to have to take a while to look at how things evolve. But it's not. If the labor force hadn't risen like that, and job creation had been the same as it was, we would now have an unemployment rate not of 3.7%. We'd have an unemployment rate of 2.7%. That's how strong job growth has been over the last year. But job growth has become increasingly narrow. It's down to healthcare. Over the last few months, all the private sector job growth has come from healthcare and leisure and hospitality. And those are industries that are going to bear close watching, because the narrower growth is, the more fragile that labor market growth is.
Has inflation been whipped?
I think it's a little soon to say. Okay. I'm glad, we have projected to come down. It has come down faster. We have to thank the Fed for that on its resolve. But we do have this challenge between the market, which says the Fed will cut 6 times this year, and the Fed, which I think had a little bit of a communication misstep in suggesting they were going to take their foot off the brake a little bit, and the market ran with that. So I think that's another challenge to be faced, because I don't see how the Fed cuts rates 6 times this year unless the economy is actually in a recession. So the markets have some sort of conflicted views, because on the one hand, what you say about corporate bond spreads and the equity market. On the other hand, you've got a fixed income market that's pricing in rate cuts that we would only expect to see, not from tweaking because of lower inflation, but because of an outright recession.
Do you see any threats to inflation coming from the current geopolitical risks and realities that we're facing at the moment?
There are always cost shocks that can come from that. You run the headlines about doubling wages of Danish workers on the vessels in the Red Sea, and the longer shipping times and so on. And there are going to be factors there, but we have to remember, inflation's a monetary phenomenon. The inflation that we experienced in 2022 may have been initially triggered by pandemic effects and by supply chain effects, but we also had the war in the Ukraine, but those things were accommodated by the central bank. So they got into parts of the economy that if it were just those shocks, we wouldn't have seen it. So policy needs to be tight enough to take away from companies the view that they can actively manipulate their margins. They could use pricing as part of their margin strategy. And it's that inflation psychology that had vanished from the US economy and other Western economies that crept back in. And whether we will defeat inflation for the longer term or not will depend on whether the Fed stays sufficiently restrictive that companies don't seek to pass on those costs or fully pass on those costs. So is it a threat? It's a threat to another cost shock. You saw in the Chicago PMI, we don't know how that's going to feed through. The prices paid jumped up to 70 in December, so 70% of manufacturing companies in the Chicago region were paying higher prices, and that was a significant step up.
John, thanks so much for joining us. Really appreciate you coming into our studio. John Riding, he's a chief economist, chief economic advisor at Breen Capital, joining us here in our studios. And again, Caroline, on the last trading day of the year, very quiet day as you would expect. A little bit of softness, but that's okay. It was a heck of a year, heck of a quarter, actually.
You got any New Year's resolutions?
Absolutely none. Too old for those. I guess I've broken them all. So, so.
I got a fun one.
Okay,
because
go.
I started playing poker a bit more in 2023.
Really?
And my resolution is to keep on doing it in 2024. My husband and I do mixed poker nights where we live. And there's one woman out there who made a ton of money in options trading, in fintech. But her key focus is training women to be able to be smart and people who identify as women, good at the poker table, and also teaching kids, because this is about probability.
Nice.
This is about risk-taking. This is about negotiation, EQ. We'll be speaking with one and only Jenny Just in a moment.
Oh, that'll be good.
This is Bloomberg.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg Markets, the final block before the new year of our 2 hours of glory. It is one Paul Sweeney, Caroline Hyde, riding into the close where the markets are a little bit meh, to put it technically. Yep. We're down on the day across the major benchmarks, but we're still up on the week on the S&P 500. And we want to sort of take a moment to think about where your focuses lie for 2024, because one of mine has been playing a little bit more poker. I really got into that in 2023, mixed poker, my husband and I, and it's something that I think is becoming more mainstream for a more diverse table to be sat around. One person who's really been a driving force behind that is, well, self-made billionaire, someone who has been at the cutting edge of options trading, at fintech, and Jenny Just co-founded Peak Six all the way back in 1997 with just a little bit of seed capital, $1.5 million. But you've gone on to just build businesses through venture, through focus, but also you're really a co-founder in Poker Power. This was a women-led company. You're teaching poker to all those who identify as female and also teaching kids, young women, to feel at home, comfortable at taking risk, laying bets, reading people. Jenny, just tell us a little bit about Poker Power.
Well, we're super excited to be here. Thank you so much for having us here.
especially at the end of the year when it seems like an exciting time to think about doing something new. And Poker Power came about because of my daughter, actually when she was 14, because of her tennis game. And her dad thought, you know, she wasn't really thinking or strategizing about the player on the opposite side of the net. And lo and behold, he thought about poker. But ironically, the two of us were not poker players, despite being from the trading industry. So we went through the exercise of teaching her, and then I learned. And what I saw in her, and then what I saw for myself, I frankly was astounded. I was astounded at the confidence building that it had for her, and we taught her friends as well. And then for myself, I actually saw my work. I saw what I do every day. Yeah. I saw that negotiation. I saw that deal. I saw that meeting. And I thought, here it is in a simple card game laid out before me, a way to practice doing those things that we do in business every single day. Things that we're not typically set up for from our hobbies or when we are young women.
Yeah.
So for my daughter, I was super excited because we were thinking, of course, about her sports. But as it turns out, it's really about any table that she sits at in life, having the confidence, and particularly the money table.
And I think it's so interesting because, you know, you speak to an Ursula Burns when she was leading Xerox, and she would say the frustrating thing was she didn't play golf particularly. And then I think of how much, you know, I would get jealous of my husband going off to be with our local friends, but they were all guys playing poker. And I asked the question, why aren't more women at this? And also whenever he used to be in the finance area and he'd be off doing poker nights. So how many women are invited tonight? Oh, only one's coming. Yeah. How much are you starting to see that conversation change? More people feeling that they can bring themselves into what has seemingly been a more male-dominated area?
So it is a real hurdle. That's what I know for sure. And what I love about poker is it's a really tangible thing where we can say, here it is today. It's like women in driving in the 20s and 30s, and here's where we want it to be. We know we want women to be equal CEOs. We know we want them to be an equal percentage of VCs being invested in or investing in others. We want all of these numbers because there's no reason why it shouldn't be equal. So how do we get there? And it was the same thing when you drove. It's not really about the cars. It was about getting to a job, getting to school. Today, this is about having ownership and leadership at the money table. And I will tell you, through poker, it is a clear opportunity for us to practice and get better at all those things that we're not naturally taught as a young girl. And we are starting to see the first light at the end of the tunnel. Certainly in poker as an industry, they've never seen that change. Nobody in the world has ever figured this out. So each woman, one by one, we can do this together. We are teaching corporates. We taught over 250 companies, which is incredible, just in the last 18 months, who are teaching their groups, their ERG groups, or through their DEI efforts, or just for their, you know, both women and male allies, because it's such a skill building opportunity. But each one of those opportunities, then people can go home. They can teach their friends. They can teach their daughters. And it's this really interesting flywheel that we're starting to produce through the companies, even though we really wanted to start with the young girls, because we know the more we practice, the more comfortable we're going to get. So it's not even going to be a question when I'm in my first job. And someone says, I think you're ready. And when a man wants to take that risk, he has 60% confidence maybe. The woman feels like she needs 90% confidence, but she doesn't actually. Mm-hmm. She can now feel comfortable with less knowledge, taking more risk. Those are the types of things that are taught at that poker table. And so we're starting to see the change. Pretty soon, it will be 50-50 at the poker table. It will be 50-50 in the trading world. It will be 50-50 where money decisions are being made. It is a matter of time. We have every opportunity as a network of women and male allies to change things immediately. Like once this gets going, it's, you know, the hockey stick will
Right.
it will be exponential.
Jenny, the only professional poker player I know happens to be a woman, Annie Duke. So I learned from one of the best. But in your industry that you grew up in the trading business, talk to us about women in the trading business. It's been one of those areas that's been really hard to break, as I understand it, from back in my day. Give us a sense of how you think that's evolving.
That's a tough one. Tougher than I think even poker, frankly. And one we've been trying to crack for many years. We started a program that it's called the Women's Trading Experience. And it's not about knowing anything coming in. That is the hardest part. It's about being smart. It's about being curious. And it's about having a really strong work ethic. That's what we found. But women just don't know about trading. It's not natural for them. I think once they start playing more poker, it will become more natural. I also think the growth in the fintech industry over the last, let's call it even just 5 to 8 years, has put so much more at their fingertip that they're curious about. Why can't I do that? Well, certainly you can. You just don't know that much or haven't been exposed to it. And so I think we will start to see more and more women. I think Peak 6 is probably the highest percentage in what I call capital allocators, women actually pressing the button. We are in the high 20s, low 30s, and we are lucky with our competitors if you see even close to 7 to 10%.
One of the things that I know is important for a lot of people is just to be able to get that concept of financial independence. And I guess poker, like trading, that's a way to get there, I guess, and teach you the value there. Is that kind of how you think about it?
Yeah, that's exactly right. So when I like to talk about, it's not okay to, at a minimum, be conversational in money, right? And the goal would be to be fluent in money, and that takes time. But one of the ways you do that is by taking risk with money. So there is no relationship in our life, personal or business, wherever it is, that is smooth. And women tend to think their money should go in one direction, which is up and to the right. And guess what's going to happen with that? It's not going to go very high. And it's not going to go very low. But I'm also not going to learn a lot. So the earlier I take risk with money, now when we play Poker Power, we're not playing for any money, right? We're playing for leadership and for the chips. But eventually that will lead us to testing it out by trading, buying that first stock, buying that first crypto, whatever it might be. And we will go on a journey. And the earlier I do it, the sooner I learn those lessons. I call it, it's like compound interest, compound experience. I need to have those experiences sooner. And when we talk about poker, every hand is another opportunity for a risk.
Okay, so say you've whet some appetite of those listening in just 30 seconds. Where do I go first to get a little comfortable if I just want to play tonight?
That's great. So first of all, pokerpower.com, you can see everything we have to offer, whether it is lessons for you sitting at your company or for you and your friends. Secondly, Poker Power Play. We have an app in the App Store, what I would, in my opinion, the first gender-neutral poker app on the market. And you can join us and you can practice right in there. You can practice with bots. You can get 5-minute lessons, tutorials to get you started. And those are the two best places that we can offer. And by the way, if someone in your family already knows how to play, teach the others in your family. It's a game for everybody. Worst case, you're going to have a lot of fun. There's a reason why so many people play poker.
Don't need to play charades, don't need to play Cluedo. Get a little bit of poker in your life these holidays. Jenny Just, joy speaking with you, co-founder of Peak 6. Thank you so much. And Paul, a joy to be with you.
Absolutely. We had a fun time this week.
We did. More soon. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
For our TV and radio audiences worldwide, welcome to Bloomberg Markets. I'm Bonnie Quinn with Shonali Basak on this final trading day for 2023, one that won't have disappointed anybody who was long this market, I think, Shonali, it's fair to say. And, you know, we may not hit a record today for the S&P 500, but we're up nearly 25%. Really interesting data point from Nick Colas at DataTrack today, suggesting that this, though, takes the S&P's 20-year compounded annual total return to 9.6%, which is actually below the long-run average.
How incredible is that?
Isn't that incredible?
It is incredible. And if you look at also even the other indices, it's interesting. We were so excited to be anchoring into the Santa Claus rally. The Santa Claus rally is fading. I don't remember which part of the bet I had. I think I'm already losing.
That's not true. I'm sure you remember. I'm going to remind you.
The Basics like to cheat at games. I said that we would hit a record today. You said we would hit an S&P record Tuesday. So you are looking like you are in the lead. You will get that peppermint latte on Tuesday if we indeed hit that record. Maybe Wednesday, maybe the next day.
Well, honestly, though, if we hit a record, I don't mind shelling out for these peppermint hot chocolates. It's really fine. But it is interesting. Let's have a look at where we stand index-wise, because we're seeing a little bit of selling, a little bit of profit-taking, I think it's fair to say, Shonali, for the few people that are out there.
It's incredible. The S&P 500 now down almost 0.3% on the day, and the NASDAQ 100 and the Dow Jones Industrial Average. I'm interested in those two because those are two indices that intraday yesterday, they hit records. And now the NASDAQ 100 down about 0.3%. The Dow Jones Industrial Average down 0.15% on the day. The Russell 2000 also down more than 1%, Bonnie.
Let's take a look at yields, because it's fascinating. On January 2nd, the 10-year closed that day at 387.48. Look where we closed today, 387.91. How incredible is that? I find it just completely fascinating that we're absolutely nowhere, having gone through all of the volatility this entire year. The 2-year yield closed the first session of January 2023 at 442.58. So we are down nearly 20 basis points on the 2-year yield, which is more susceptible to the idea of inflation or lack thereof. And I think it's worth pointing out that we are getting a couple of warnings today. RBC saying the risk of recession has gone down modestly, but the market is pricing that it's gone down remarkably. So we should remember that. And also Larry Summers saying that investors are probably underestimating inflation risk. So plenty of people out there still warning, not just about inflation, but also recession, Shonali.
Yeah, and while we have fears about potential recessions in the future, we also have market fears in the near term. Underpinning these somewhat calm markets is actually quite a lot of volatility in the repo market. The era of calm, Vonnie, is over for the repo market. The secured overnight financing rate, or SOFR, has risen to the highest level since it was introduced more than 5